Okay. Good morning, everyone. So today is for this month, the last session on financial instruments. We will be discussing accounting for derivatives today and post accounting for derivatives in the next two sessions in June, which is 4th June and 11th June. We'll be discussing problems as well as a couple of small concepts here and there which are pending. Okay, not so important from an examination perspective, but we'll discuss that. Okay. So coming to yesterday's closure, we had to start accounting for derivatives. So derivatives are basically, they could be a financial asset, they could be a financial liability, they could be equity also. Okay. So now, if it is financial asset or a financial liability, they go under FVTPL. And if it is equity, we are going to value it at initial recognition, and that's about it. So we had stopped here and we had said that we'll pick up a discussion today based on a question. So we had read the question also yesterday. Okay, so it is illustration 3 on page number 12.197. So with the help of this, I think we will do the accounting of derivatives entirely. Okay, we'll do a couple of extra points also for this question, which is not mentioned here. So that should give you a complete idea of how derivative accounting is going to happen. Okay. So on 1st January 20X1, Samco agreed to purchase $20,000 from JT Bank in future on 31st December for a rate equal to 68 rupees per USD. Okay. So this is illustration 3, page 12.197. So I am Samco, and on the other side, I have JT Bank. Okay. So both of them enter into a contract. Both of them enter into a contract. What is the contract for? It is a contract for purchase, agreed to purchase. So this is a forward contract. Okay. So forward contract. To purchase $20,000. To purchase $20,000. Second. To purchase $20,000 on 31st December 20X1. Am I right? Yes, at 68 per dollar. Okay, and when did they enter this contract? They entered into this contract on 1st January 20X1. Okay, so this is the contract which is there. Okay, so now we have to do the accounting. Okay, what they have asked is, following the principles of measurement and recognition laid down in 109, record the entries for each quarter. Okay. So for the purpose of accounting, please use the following information. You are given the movements in the fair, you are given the fair values basically. Spot rate of USD on 31st December 20X1 is 66 per USD. Okay. All right. So now, without any further discussion, as of now, tell me, is Samco Limited making a profit on this contract or making a loss on this contract? Okay, a very simple question. You don't have to break a lot of your head. On the contract, what is Samco incurring? Or what is Samco earning? Is it earning a profit or is it earning a loss? That is the first thing we have to understand. So on 1st January, I have entered into the contract. On 1st Jan, it is just an agreement you are signing. You are not really exchanging any money. Okay, so there is no exchange of money, no resources exchange. It's just a contract. So on 1st Jan, no cash outflow. When are you agreeing to purchase? You are agreeing to purchase after 1 year. That means on 31st December X1. So you have agreed to purchase $68 at the rate of 68 per US dollar. Whereas on 31st December, the price is 66 per US dollar. So you tell me now, what is Samco Limited going to pay? Is it going to pay 68 per dollar or will it pay 66 per dollar? Please remember, this is not an option contract. This is a forward contract where I am obligated to purchase for the price that is agreed, where I am obligated to purchase for the price that is agreed. So as on 31st December 20x1, the market price is 66, but I have contracted to purchase the dollar at 68. That means compared to the market, I'm paying 2 rupees per dollar extra. So this is running into a loss. And that is why 2 into 20,000, the overall loss on this contract is 40,000 rupees. Okay. So this is just a fair idea that once you do the journal entries, this kind of a loss, you should be able to somehow link up your figures and ensure that they match up. Okay. All right. So now, is it a derivative? So the first thing that you will answer is the contract a derivative? This is the first question that you will ask yourself. So for a derivative, there are 3 questions you have to answer. If the answer to that is yes, then it is a derivative. If the answer is no, then it is not a derivative. So first one is there an underlying? Answer is yes. Dollars. Dollar currency is the underlying asset. So the value of this forward contract will vary depending upon the changes in the value of the dollar. Okay. Second one. Is it settled at a future date? Answer is yes. On 31st December 20x1. That is after a period of 1 year. So it is settled at a future date. And third question that you have to answer is amount paid initially nil or insignificant? Answer is yes. So the answer to all the questions, fortunately, is yes. And therefore, contract is a derivative. Therefore, contract is a derivative. So for any question that looks to be a derivative question, you have to answer these 3 questions first. And this you have to present in the answer also. Okay, you have to give this discussion in your main answer as well. Okay, so now once this is done, it is a derivative. It is a derivative. Okay. Is it derivative financial asset or is it a derivative financial liability or is it a derivative equity? What it is? What is it? Okay. Is it a derivative financial asset or is it a derivative financial liability? Or is it a derivative equity? Or is it a derivative non-financial item? See, please remember, you are assessing this on 1st January. You are assessing this on 1st Jan. Yahan pe data is given, so you know that it is a loss. But on 1st Jan, when I'm entering into the contract, do I know that this will result in a loss after 1 year? I do not know. So therefore, think and tell me, is this going to be a financial asset, or is it going to be a financial liability, or is it going to be an equity, or is it going to be a non-financial item? So first one, not equity. Sir, why not equity? Because settlement is not in own equity instruments. So ये वाला चला गया. Okay, it is not equity. Okay, second one, non-financial item. अरे कहाँ it is a financial item. कैश मिल रहा है आपको. Not a non-financial item, as it is for currency exchange. Okay, so therefore this also is cancelled. And now we are left with third one, financial asset or a financial liability. So what it is? Could be either. Could be financial asset or financial liability, as the case may be. You cannot pinpoint and say that it is a financial liability, because as on the date of entering into the contract, I do not know whether I will have an obligation to deliver cash or whether I will have a right to receive cash. Suppose in this contract, the rate in the spot market was 70 and you had a contract for 68. And you opt for net settlement. Are you able to connect the terms now? We had studied net settlement long time ago. I think in the first or the second class. If this is a net settlement contract, let us assume that the spot rate on 31st December is suppose 71 rupees per dollar. You have a right to purchase at 68. So you will tell the bank, Samco will tell the bank, see, I have to pay you 68. You have to pay me 71. Do one thing, we'll net settle the contract. You pay me 3 rupees per dollar. 3 into 20, 60,000. So if it becomes 71 on the 31st December, the date of settlement of the contract, and I have opted for net settlement, it is converting into a right to receive cash on 31st December. And therefore, sitting on 1st Jan, I cannot identify whether it is a financial asset or a financial liability, because the problem is I'm also getting a currency only in return. Are you able to follow? So it doesn't really matter whether it is a financial asset or a financial liability, because दोनों का accounting तो same ही है. Whether it is financial asset or a liability, both of them will go under FVTPL. Okay, so you have to recognize whether it is equity or a non-financial item. If it is neither, then you will do a simple FVTPL accounting. Are we clear till now? Yes, अपने को बात समझ में आ गई? Yes. So now coming to the thing which we are most comfortable with, journal entries. Journal entries. Yes. Journal entries. Are we clear till now? Everyone, thoda sa bhi doubt hai, then please feel free to ask. Okay. Even if you have one doubt, one small question, even though it may appear silly, don't worry. Please ask. Okay. So if nothing is there, we shall proceed further. Okay. For derivative financial asset, won't we need to check CCFC, SPPI, held to collect? Okay. You tell me, what is a basic lending arrangement? Don't forget the definitions, or don't forget the reason why there is the CCFC test, or don't forget the reason why there is an SPPI test. In a basic lending arrangement, what are the things that you are expecting? Sir, in a basic lending arrangement, we expect we expect compensation for credit risk. We expect compensation for credit risk. We expect compensation for inflation, and we expect a reasonable profit margin. So these are the only three things that you are expecting. Now, in the case of a derivative contract, do you think this is a lending arrangement that you are entering into? The first point. Second point is, when you look at the chart that we had prepared initially, one second, let me share it with you. This one. Accounting. In the very initial chart which I had shared with you for accounting, all right. There are three accounting models for financial assets: amortized cost, FVOCI, and FVTPL. All right. Now, when you come to amortized cost accounting, you can have amortized cost or FVOCI only if you meet the CCFC test, and after the CCFC test, you pass the business model test. Okay. Now, in the case of a derivative, is it a basic lending arrangement? It is not a basic lending arrangement. You are not lending the money to get it back in the future. All right. You are entering into a contract to kind of safeguard yourself against the price movements that will happen in the future. That is what is a derivative. Okay. It could be entered into for speculative reasons. It could be entered into for mere price protection, for hedging your position, whatever it is. But it is not a held to collect cash flow. Are you able to follow? And because it is not a held to collect or even held to collect and sell asset, it does not meet the requirement of FVOCI as well as amortized cost. So all derivatives are outside the purview of these two methods of accounting, because they don't meet the CCFC test or the SPPI test. Okay, it fails. So you can also check here in our accounting, derivatives have to be at FVTPL. Derivative or held for sale or trading assets, they have to be at FVTPL. It's mandatory. Okay, it is mandatory because it does not fall into that category. Investment in equity shares we have seen, and all other financial assets we have seen that we have to perform the CCFC test and the business model test. Okay, so her question is done. Now coming to equity point. Okay, I don't know. See, this derivative is not a contract for exchanging own equity instruments. Okay. It is a contract where you are getting the dollar and you are paying in rupees. So you are getting currency ke samne you are paying another currency. So it is not a contract in own equity. Okay. So we will be treating it as a financial asset or a liability as the case may be, and enter into a fair value accounting. Okay. Namrata, let me know whether you have understood. Yes, Kaushiki is okay. Janvi, is it clear till now? Tushar and Viraj, is it okay? Yes, all clear? Okay, fine. So at this stage, we now start the journal entries. So the first entry is on 1st January 20x1. What is happening on 1st January 20x1? Okay. Sir, on 1st January, I am entering into a contract with JT Bank. So Samco is entering into a contract with JT Bank. Okay. So what will be the entry that you are going to pass? Sir, I can pass an entry, financial asset account debit to bank. Financial asset account debit to bank. Can I pass this entry? I can pass, provided I'm paying something. You are merely entering into a contract. That means what? Abhi to aapne sirf contract sign kiya hai. You have not paid anything. You've just agreed to pay. So basically, are you paying an amount? Answer is no. We will look at a modification of this jahan pe option contracts are there, where there will be a premium payment that will happen at the time of entering into the contract. We will look at the impact of that as well. Okay. But right now, I'm not paying anything. So therefore, Samco will have no entry. No entry. Why no entry? Is it because of your wish, your choice? Answer is no. You don't have an entry because you've not paid anything. Why have you not paid anything? Because the contract does not require you to pay now. So can I say that on the initial date, the fair value of this contract is nil? See, what is fair value? Fair value is the transaction price. And transaction price is basically the price that what you can say, that a buyer and seller enter into in the principal market, the fair value definition which we discussed. So therefore, Samco and JT Bank are market participants. They enter into a contract on 1st Jan. Payment is not made. Can I say that payment is zero? And payment is zero. It is a transaction between market participants. It is the fair value. So can I say that fair value is nil on 1st Jan 20x1? I can say that. Yes. So therefore, no entry, because no initial payment is made. Hence, fair value equals nil. Hence, fair value equals nil. You are just entering into the contract. So as on this date, there is no fair value to it. Okay. No initial payment. And from this date, there will be a movement in the fair values. Why, sir? Because the value of your paper, the contract which you have signed, will now start to gain the benefit, will now start to, what you can say, the value of this contract will now move depending on the movement in the currency rates, depending on the movement in the currency rates. Okay. So coming to 31st March 20x1. Coming to 31st March 20x1. Acha. So as on this date, the fair value of the contract, use the following information representing mark to market fair value. So this is a fair value of the forward contract. The fair value is negative 25,000. The fair value is negative 25,000. What do you mean by negative 25,000? It means that the contract has gone against you. The contract has gone, the prices have gone against you. Okay, that means you have entered into a contract to buy the dollar. The dollar rates have increased. The dollar rates have increased, and because the dollar rates are increased, the value of your contract is going down, and it has gone down by 25,000 rupees. That means if you enter into a net settlement now, you will have to pay 25,000 rupees to JT Bank. Is it okay? So as on this date, the dollar price has gone up. So if I have to just give a way of explaining it, if I have to just give an alternative way of explaining it, it can work like this. Okay. You have entered into a contract to purchase at 68. Okay. So 1 second, please. 68 into 20. So in a manner of saying, on this date, the rate is 68. Okay, so on this date, the dollar rate is kind of saying that it is 66.75 per dollar. Okay, it is 66.75 per dollar because you have a contract for 68. The spot rate is 66.75. So you are incurring a loss on this contract. That fair value gap, ignoring all, it's not so simple. Okay, it's not so simple. First of all, you have to understand, itna aasan nahi hai. There are a lot of factors into play, but in a very crude manner, I'm just saying that probably the spot rate of the dollar would have been close to 66.75 per dollar. But don't take this as a benchmark because there are other factors at play. But this is just for our understanding. Probably the dollar rates have gone down and therefore your contract is losing value. The value of the value of the loss on your contract is coming to 25,000. Okay. So this is just for your kind of a simple understanding. Okay. All right. So now you have a contract, you have a derivative contract that has made a loss. So what Ind AS 109 tells, immediately book the loss, immediately book the loss. I am in the books of Samco Limited. I am in the books of Samco Limited. Okay. Not JT Bank. Okay. So therefore, here the entry is going to be fair value loss on derivative, which ultimately goes to the P&L debit. And now if I look on this date, I am having a derivative financial liability of 25,000. I am having a derivative financial liability of 25,000. Okay. Is this entry clear? Bolo, everyone, is this entry clear? Yes. So I have recognized a fair value loss. Okay. Because the dollar rates went adversely to my contract and therefore my piece of contract, the value of that has gone down by 25,000 rupees, which is resulting into me having an obligation on my head to the extent of 25,000. Okay. Is it okay, everyone? Yes. Is it okay? Are we able to follow? Namrata, Tushar, Vidit. Bolo, are we able to follow? Any doubts so far? Anybody has any doubts so far? Okay, all right, it's clear. So next, coming to 30th June. 30th June. Okay. The fair value as on this date is negative 15,000. Fair value as on this date is negative 15,000. That means what? It was 25 earlier. It has come down to 15. So can I say that the incremental is a fair value gain that you are incurring? The incremental is the fair value gain we are incurring. Answer is obviously yes. So therefore, it is Namrata, I'll come to that point. Okay, what you have asked. Just give me some time to complete the journal entries. Then I will discuss that. Derivative financial liability account debit to fair value gain on derivatives, which I take it to the P&L. This is 10,000. This is 10,000. Yes, we have reversed 10,000. Absolutely right. Okay. Anybody has any doubts till now? Plain, simple FVTPL mark to market accounting. That's it. Are we clear, everyone? Yes. Okay. 30th September 20x1. 30th September 20x1. Okay. Now, on 30th September 20x1, the fair value is positive. That is 12,000. So you have to reverse the 15,000 which is remaining and also recognize the gain of 10,000. This is where our standard gains or is more advantageous compared to AS. Okay. AS would not allow you to book this gain citing conservatism principle. But yahan pe वैसा नहीं है. There is a fair value gain. It is a factual gain. Your prices have gone up. So your contract has become more valuable, and therefore go ahead and recognize the fair value gain in your books. So therefore, derivative financial liability debit 15,000. It now gets converted into an asset. Debit 12,000 to fair value gain on derivatives, which we take to the P&L. 27,000. That's right. That's right. More practical, more realistic. Okay. All right. To fair value gain on derivatives. 27,000. Okay. Is this entry set clear till now? You would not see a fair value gain under accounting standards. Okay. Basically under AS, this would not be accounted at all. I'll come to that after I finish the journal entries. Okay. I will tell you what we would do in AS and why this is better than that. Okay. But basically for any other reason also, a fair value gain in the P&L was something which was never recognized. Okay. In fact, IFRS are even more flexible than Ind AS. Okay. IFRSs are even more flexible than Ind AS. For instance, you would have studied Ind AS 40 on investment property. So in Ind AS 40, we are required to disclose the fair value, not to record the fair value. Okay. Whereas under IAS 40, investment properties have to be compulsorily fair valued. Not only that, the fair value gains will go to the profit and loss. It won't even go in OCI or reval reserve. So that is the way you would do the accounting under IAS 40. Okay. Similarly, in IFRS 3, that is our Ind AS 103, we have something known as a gain on bargain purchase when we purchase or acquire companies. So a gain on bargain purchase under Ind AS 103 would always go into capital reserve or other comprehensive income, and from there it would be routed through the capital reserve. But in the case of IFRS 3, even a gain on bargain purchase or a profit that you make on an acquisition, that profit also you can take it to the profit and loss. Okay. So IFRSs are even more flexible for certain aspects, and they are strict also for some other aspects. Okay. It's not that way. It's just that, for instance, in Ind AS 1, I think you have a loan that you have defaulted, but you have made, and which a non-current borrowing that you have defaulted. As a result, it has become payable on demand. You remedied the default after the balance sheet date, but before the accounts were issued, then you could continue to treat it as a non-current liability. But IAS 1 says remedying it after the balance sheet date is not good. You have to treat it as a current liability. So there are these carve-ins, carve-outs which always exist. Okay. All right. So 30th September ho gaya. We then move on to last date, that is 31st December 20x1. 20x1. This is the settlement date. This is the settlement date. Okay. So we will do two settlements. They have not asked it, but we will do one of the two. Okay. You will do one of the two, obviously. So this will be gross settlement, and this will be net settlement. Okay. Now, if I talk about gross settlement, I will get the dollars, correct? I will get $20,000 and I will pay the contracted amount. Are you able to follow? मेरे पास क्या आएंगे? I will get $20,000. It will come in my bank account and I will pay at the agreed rate of 68 per dollar. So in sum speaking, it looks something like this. Bank account debit. I'm writing a very funny entry right now. $20,000 to bank account $20,000 into rupees 68 per dollar. So 68 into 20 कितना आता है? 13,60,000. Okay. Okay, so this is the actual transaction that happens. You are getting $20,000 and for $20,000 you are paying 13,60,000. अरे sir, but ये ऐसे कैसे हो सकता है? You are recording in two different currencies. That is why we now refer Ind AS 21. We now refer Ind AS 21. Ind AS 21 tells us that you have to book any foreign currency transaction at the spot rate. So the actual entry that you will be passing is bank account debit 20,000. On this date, the spot rate is 66 per dollar. So 20,000 into 66, that gives you 13,20,000. 13,20,000. Okay. All right. So you are getting dollars worth 13,20,000. Okay. To bank. आप कितना पे कर रहे हो? You are paying 13,60,000. Yes or no? You are paying 13,60,000. Is it done or anything is left out? Is it done or anything is left out? You are paying 13,60,000. Is anything left out or can I proceed to balance with 40,000? Can I proceed to balance with 40,000? You tell me, is there anything left? Okay. So I got an answer saying that, sir, take it 40,000 to the P&L. I'm asking, is there anything else that is pending? There is na. ये derivative financial asset is there ना, जो आपने recognize किया है. See, liability तो चला गया. I recognize 25,000 minus 10. So this comes to 25 minus 10, 15. 15 minus 15 is 0. But I have a derivative financial asset. Now I'm settling the contract. So when I'm settling the contract, I will have to reverse this 12,000. इसको हम रख नहीं सकते. So we will reverse the derivative financial asset to derivative financial asset 12,000. So this gap of 52,000 is what will go to loss on settlement. Okay, fair value loss, which goes to the P&L. But sir, अभी तो आपने कहा था थोड़े टाइम पहले, just a couple of minutes ago, you had said the loss on this contract is 40,000. Here we are getting a loss of 52,000. Loss of 40 ही है. I will show you how it is a loss of 40,000. Okay. We'll show you how it is a loss of 40,000. Okay. Your P&L. Okay. So this is done. Okay. Let us move to the next one. Net settlement. In the case of net settlement, what you are going to do is you will ultimately tell the bank, look, you have to give me dollars. See, that is the money which you are getting in dollars, no? Are yes or no? You are ultimately getting US dollars, no? वो कहाँ आएगा? That will come in your bank account only, no? Yes, that will come in your bank account only. So that is why bank account debit. Why am I using 66? Because this is the spot rate on the date of the contract, on the date of the settlement. So bank is not going to give you 68. Bank is going to say the market rate is 66. I will give you 66 per dollar. You want $20,000. I will put 13,20,000 in your bank account. Okay. Is it okay? Yes. And that is what Ind AS 21 also tells us. For any foreign currency transaction, you will be entering it into at the rate that is prevailing on the date of the transaction. Is it okay? Yes. So 13,20,000 is for that reason. Okay. All right. Now net settlement. I will tell the bank, देखो, I have to pay you 68. Samco will tell JT Bank to JT Bank, and you have to pay me 66. Let me do one thing. I will pay you net 2 rupees. Okay. And I will buy the dollars separately. Okay. So 2 rupees I will pay him. So 2 into 20,000. So my net outflow will be 40,000. Okay. To bank. Chalis. How did I get this 40? Rupees 68 per dollar minus 66 per dollar into, I'll come to 52,000. Janvi, just wait for some time. I will come to 52,000. Okay. Just give me some time to explain. As of now, you just understand that it is a balancing figure. We are all getting confused probably because we saw 40,000. We are seeing 52,000. So that is why we are getting confused. Just let me complete the net settlement and show you 2-3 things. And then we sort out the issue of 52,000. Okay. Just bear with me for some time. Okay. Into $20,000. So this is the net payment which I'm going to make. Okay. Now, once the derivative contract has been settled, I cannot have a derivative financial asset lying in my books. So I will credit the derivative financial asset 12,000. So I'm going to have a fair value loss in the P&L debit 52,000. Okay. So this is my position under net settlement. I'm not going to buy the dollars from the bank. I'm saying to the bank, I will pay you 40,000. You are settled. And that's the end of the contract. Okay. So to derivative financial asset 12,000 and the fair value loss is ultimately 52,000. The important point you have to remember is whether it is gross or whether it is net, these two figures will always be equal. Whether it is gross or whether it is net, the fair value loss or the loss on settlement that is going to be there, that will always be equal. Okay. So the modes of settlement don't matter to arrive at the loss or gain on the date of settlement. Okay. So this is what is gross settlement and net settlement. And now we look at the impact on the profit and loss. Okay. We now look at the impact on profit and loss account. On 1st January 20X1, did I incur anything? Answer is no. So nothing has hit the P&L on the date when you entered into the contract. When you move further to 31st March 20X1, you incurred a loss of 25,000 due to fair valuation movement. So you have incurred a loss of 25,000. On 30th June. On 30th June 20X1, you have made a gain of 10,000 if I remember correctly. Yes. So the fair value is now at 15,000. On 30th September 20X1, what have you done? Sir, I have made a gain of 27,000. All these entries you have only told me. Okay, so you can refer it. You have made a gain of 27,000. And on 31st December 20X1, I have booked a loss of 52,000. Okay, so this is the total fair value movements that you are showing throughout the year. The fair value gains, losses that are there. So minus 25 plus 10 plus 27 plus 52. You do the total of this, it should come to 40,000. It should come to 40,000. This is the net position for 20X1 on this contract, which has already been settled. Are we able to understand this now? Yes. The very first time today when I read this problem, I told you that the overall loss on this contract is 40,000. Bola tha maine? Yes. Is the overall loss coming to 40,000? Answer is yes. Sir, difference kya? Difference is I have booked this 40,000 throughout the financial year. I have booked this 40,000 with fair value movements throughout the financial year. वो क्यों किया? I will explain. But as of now, did you understand the question? Did you understand the question till now? Please tell me honestly. Okay, Janvi, tell me now whether you have understood 52,000. As of now, tell me whether you have understood 52,000. Is it clear? Okay, Tushar has confirmed, Viraj has confirmed, Kaushiki has confirmed. I'm waiting for Namrata. I'm waiting for Janvi if she has any doubt. Vidit, is it clear? Yes. Okay. So, the 52,000 also is clear, Janvi, or you still have any doubt? Yes. Okay. So, essentially, what I'm doing is I'm taking 40,000 over the entire period. Okay. That is what is the accounting that is now happening. Okay. Are we clear with the accounting? Yes. Yeah. Okay. Shubham is also there. Good. Okay. So, overall on the contract, I have made a loss of 40,000. Overall on the contract, I have made a loss of 40,000. Okay. This loss of 40,000, now let us understand what we used to do under accounting standards. What we used to do under accounting standards was, sir, derivative contract is there. I have entered into the derivative contract. So 1st of Jan, nothing was paid. So therefore, no entry would come. In between, anything could happen. So this was the mindset that the standard setters had put on us, that anything can happen in the middle. Apne ko kya lena hai? See, the contract is being settled on 31st December. Uske pehle to nothing is happening. So therefore, the standard setter says, whatever happens, dharti akash kuch bhi ho jaye, you will not do the accounting of the contract during the entire year. Whatever happens to the contract movements, don't record it. You will do the accounting only when the actual settlement happens, because that is when we get a very clear picture. So this was what was mandated. So under AS, what you used to do was, you would do a straight accounting on 31st December 20x1. अच्छा, क्या entry pass करते थे? I would pass the entry bank account debit 13,20,000. You would receive the USD. Credit bank account 13,60,000. So ये होता था fair value loss, P&L. This was a single entry which was passed on 31st December 20x1. Nothing else. Okay. Now, what was the problem with this? What was the problem with this? And this is why Ind AS or IFRS or even US GAAP had these modifications. See, what happened is you are having, this is one contract. You are probably not able to understand the materiality of this. Acha, by virtue of this contract, हम लोग क्या करते थे? We used to disclose in the notes that I have a derivative contract to purchase dollars at so and so rate, and that is it. Okay, since the loss or gain on that contract depended upon currency movement in the future, which was not entirely under the control of the organization, we would treat it as a contingent liability under AS 29, and we would do a disclosure. And because we would do a disclosure, these items did not hit the P&L at different dates during the year. It did not hit the P&L at different dates during the year. So what happened was, notes itna detail mein nobody studies. So you had the Lehman Brothers that collapsed. You had a large number of US banks that collapsed somewhere in 2007, 2008 ki baat hai ye, 2008. So that time, these banks collapsed like a pack of cards. Why? One is your prices started falling down, and because of prices starting to fall down, the derivative contracts which the companies had taken, the derivative contracts started to make huge losses. अच्छा, ये loss book में नहीं दिखते थे. See, if I had to record the derivative contracts on the date of recognition and the fair value movement, my investors would be aware of it. The people whose public money is invested would be aware that the bank's situation is precarious. But ये तो भाई दिखता नहीं था, because the entry would happen only at the time of settlement. It was all in contingent liabilities, and banks have huge amount of derivative contracts. Since this value started to go down, the reduction in value started much earlier. But by virtue of our accounting standards, it was not recognized in the books. वो suddenly पूरा झटका, the entire loss was booked on settlement time, and it was too late to take any corrective action by then. So your Lehman Brothers sank, innumerable banks sank. So therefore, they came out with this model of accounting. Now, in the current model of accounting, do I need to disclose derivative contract separately? Are disclose kya kar rahe ho? You are accounting for the derivative contract. These derivative contracts is coming in the P&L as a fair value gain or loss. At the same time, it's disclosed on the balance sheet itself. There is no question of disclosing separately in the notes, because now an off-balance sheet item is becoming an on-balance sheet item under Ind AS. And therefore, though I am incurring a loss on 40,000 on 31st December, uska hint is already there on 31st March. 9 months advance only I have an indication that this contract can make a loss of 25,000. So therefore, the readers will become alert, the management will become alert, and accordingly, corrective actions, if required, can be taken to mitigate these losses. Are we clear with this? Yes. So that is why this is a better financial reporting that has been achieved. In the initial cases, we never used to do accounting at fair value. वो बोलते थे notional है. अरे, if it is notional, it is notional. That is okay. But my readers and the management, more importantly, will become aware that probably somewhere in the future, this contract can make losses. Is it okay? Yes. Are we clear with the accounting scheme? Yes. Sure. Everyone. Have you understood? Yes. Viraj, Tushar, Vidit, Namrata, Kaushiki, Janvi, Shubham. Are you guys able to follow? Yes. Are we able to understand? Yes or no? Okay. Namrata, is it clear to you? Janvi, is it clear? Yes. Can you suggest a company to view derivative accounting in their financial statements? Okay. See, you can pick up ideally any contract like oil. Reliance also could have derivative contracts because it enters into oil futures or oil forward contracts. Okay. So you can pick up any of the listed companies. They would typically be having forward contracts. Companies like Infosys or even TCS could be having derivative contracts for for hedging for their dollars that they are going to receive. Okay, so they could be having a contract for that. Okay, so you can refer it in there. So we are seeing to put in the extracts wherever possible in the revised study mat as well. So there you can have a look at that. Okay. All right. So this takes care of the part. And this ends the question. This ends the question. Okay. Now let us move beyond the requirements of the question and let us try to understand how situations would require accounting to be done. Okay. Now, suppose instead of dollars, you are buying, you have entered into a contract for purchase of Reliance Industries shares. So Samco has entered into a contract with another entity for purchase of Reliance Industries shares. What would be the change? The only change is bank account debit होने के बदले investment in Reliance Industries would be debited. Investment in Reliance Industries would be debited. Okay, so that is the only change which will happen. Rest all accounting remains the same because sir ये तो equity instruments है, correct? This is equity instruments, agreed. But if it is an equity instrument, किसका है वो? Is it Samco Limited? No. It is some third entity's equity instrument, and therefore for you it will remain a financial asset only. Okay, so therefore it is not settlement in own equity instruments, it is settlement in equity instruments of another entity. So same principles of accounting will follow. Okay, all right. Which question 3, beta? You are speaking of question 3. Please tell me which question 3, Janavi. Not calculated present value, EIR is different. Okay, let me know. Okay, fine. So that is just a financial asset. So investment in equity of another entity. So same accounting will flow through. Okay. Now, suppose it is not a financial asset or liability that you are getting, as well as it is not equity. इनमें से कुछ भी नहीं है. It is a commodity. Suppose these were wheat forward contracts. Wheat, गेहूं समझते हो? Yes, this is a contract to purchase wheat, and you have entered into this contract, and you have entered into the contract to protect yourself from price fluctuations in wheat, and because of that, you are a wheat dealer basically. Okay, you buy and sell wheat. So this is for your own use. So there is an own use exemption we had discussed when we saw derivatives. Yes. So this is own use exemptions. So you understand now. First of all, financial asset or derivative contract. A derivative contract to purchase currency or sell currency. It is resulting in receiving financial asset or paying financial asset or paying cash. Okay, so basically there is an inflow outflow of financial asset or resulting in a liability, and therefore it is covered under Ind AS 109. Even if we spoke about equity, then also it is resulting in equity instruments of another entity, then also it is resulting into getting classified as a financial asset only. However, in the case of commodity, net settlement would require an obligation to deliver cash or a right to receive cash. So net settlement also would be under Ind AS 109 for commodity contracts, but gross settlement requiring delivery of the product to you for your own use means that this is a contract that is entitling you to purchase a non-financial asset. And because it is entitling you to purchase a non-financial asset, would the contract be covered under Ind AS 109? Answer is no. And since it would not be covered under 109, suppose I have a contract here where the contract was to purchase wheat, at the rate of 68 per kilo, at the rate of 68 per kg, and you entered into a contract to buy 20,000 kgs of wheat. So now, will I pass an entry on 1st of Jan? Answer is no. Will I pass the entry on 31st March? Will I pass the entry on 30th June? Will I pass the entry on 30th September? Answer is no, 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 no. Because all these are not, will be done only if it was a financial asset or a financial liability. आपका तो financial asset ही नहीं है. It's not a financial asset. But sir, 31st December को when I procure the wheat, I'll have an obligation to deliver cash. अरे कहाँ obligation होगा at this stage? On 1st of Jan, do I have an obligation to deliver cash? Answer is no. Your obligation will come into existence when the wheat is delivered to you. When the wheat is delivered to you. Okay. उसको हम लोग बोलते हैं executory contract. It is an executory contract. Okay. And therefore, it is out of the purview of financial instruments. It is out of the purview of financial instruments. Is it okay? Are you able to follow? So what would we do? I would do the accounting straight away on 31st December by passing the entry purchases of wheat account debit to bank. Sir, fair value loss? Arey, I don't need a fair value loss. It is plain simple accounting under Ind AS 2. Okay. This is your inventory. Inventory जब purchase करोगे, what are you going to record? You will record it based on the price that is existing on the date of the transaction. And that is nothing but 20,000 kgs into rupees 68 per kg. That's it. You don't have to break your head on anything. The only time you will have the entry is on 31st December. That's it. So fair value movements, fair value losses, nothing will be done. This will happen if you are entering into a gross settlement. This will happen if you are entering into a gross settlement. Arey, if wheat is delivered on 30th June, then you will book a normal credit entry, no? Purchase account debit. Suppose if wheat is delivered on 30th June, it will be purchase account debit to creditors. And if you pay it on 30th September, on 30th June, you now have a financial liability. Because the contract is executed by one party, they can demand cash from you. So this becomes a financial liability. On 30th September, when you pay it off, you will pass creditors account debit to bank. Simple accounting. Unnecessary, don't get confused. Okay. Simple sa सीधा accounting hai. Non-financial items, when are you going to book? Sir, I will book only when I get the material. No, when the risks and rewards are transferred to me, only then I can book that asset or the purchase or inventory, whatever it is. Okay, fair enough. अपने को समझ में आ गया? Have we understood this? Janvi, did we understand? I'll come to that test your knowledge question. Okay, just give me some time. Okay. Are we clear about this? Yes. Is it okay? Kaushiki, is it fine? It is not confirmed yet. Kaushiki, is it fine? Yes. Is it clear, everyone? Okay. Please explain from this entry part, sir. Which entry part, Tushar? You want me to explain the whole set of entries or only the wheat entries? The non-financial asset entries. What do you want me to explain? Yes, bolo. Okay. The wheat one, see, suppose you have entered into a contract on 1st Jan to purchase 20,000 kgs of wheat at 68 per kg. Okay. Do I have an obligation to deliver cash? Answer is no. Right now, you don't have an obligation. Why? Will you deliver cash without receiving the wheat? अरे सीधा सीधा accounting करो ना. It's general accounting. Okay. When am I going to pass the entry purchase account debit to creditors? Suppose I enter into a contract on 1st of Jan for receiving the wheat on 31st December. When are you going to book a creditor liability? Will I book on 1st of Jan? Creditor आके बोलेगा पैसे दे दो. You have booked me as a liability. Give me the money. अरे डेबिट किसको करोगे? What are you going to debit? Sir, I will debit. Yeah, there is nothing you can debit. So therefore, on 1st of Jan, no entry will be passed. 31st March, nothing will be passed because this is a non-financial instrument. Okay, it is not a financial instrument. You are doing a gross settlement of a commodity. So it is a right to receive a non-financial asset. And therefore, it cannot be covered under financial instruments. So 31st March is not there. 30th June is not there. 30th September is not there. Acha. Sir, but we can pass an entry for fair valuation movements. Debit kisko karoge bhai? See, if you want to pass an entry for fair value movements, there should be an initial contract that you are recognizing. We are not recognizing a contract. Okay, we are not recognizing anything on 1st of Jan. So therefore, the fair value movements also cannot be recorded. And that is right also, because this contract is for own use. That means you are going to consume this wheat by selling it to your consumers. And therefore, we call it as an own use contract. And therefore, it is covered under own use exemptions. So 1st Jan, date of entering, no entry. 31st March, 30th June, 30th September, fair value movements, no entry. Why no entry? Because the contract is still in an executory stage. It is not yet executed. So I cannot recognize a liability. Sir, it's getting executed on 31st December. The wheat comes into your go down. So on this 31st December, you will actually pass the entry purchases account debit to bank if you are paying, or to creditors, Is it okay? Yes. Are we able to understand now? Thereafter, it will be a regular Ind AS 2 and Ind AS 2 accounting. That's it. Nothing else. Is it okay? Yes. Are you guys finding it interesting? So we'll just write a couple of points for this one. Okay. I think we'll write a couple of points. Question is done per se. Okay. So first point is, Okay. Okay, Viraj, I'll come to your query. Okay. I'll come to your query. Okay. If contract is for purchase of equity share or bond of another entity, okay, then so this is the first thing. If contract is for purchase of equity share or bonds of another entity, then instead of debiting bank on settlement, I will be debiting investment in equity shares or bonds. Okay, so this is the first thing. So I have done the accounting for the other entity, for the other asset also, apart from USD. Okay, next one. If the contract is for commodity derivatives, covered by own use exemption or net settlement, excluded from financial instruments, and contract is executory till date of settlement. Hence, no entry to be passed. No entry to be passed till settlement takes place. On settlement date, on settlement date, okay. Okay. On settlement date, purchases wheat debit to bank or creditors as per Ind AS 2 when risks, rewards are transferred to, when risks or rewards are transferred to the entity. Okay, so this is the accounting for an executory contract. Net settlement covered under financial instruments. Same accounting treatment as above for financial instruments. Are we clear with this? Yes. Whatever I spoke, I gave you in writing. Okay. Okay. Yes. Once you have noted down, please let me know. Once all of you have copied, please let me know. Just give me a minute. Okay. All right. Viraj, you have to improve on the speed portion of your examination, okay, which comes only through practice. Just a second. Okay, I'm sorry for that. Last 1 week, 10 days, nobody is there in my family around. Okay, so managing the whole house. Okay, all right. So the issue is you will have to improve on the speed portion, Viraj. Okay, so always try to ensure that you attempt at least 85 to 90. So improvement of speed can happen only with the practice under exam conditions of mock test papers, mock examinations, previous papers. Okay. Largely the questions come from study mat, okay, or RTPs or MTPs, whatever it is, okay. So you can have a practice of covering the the past RTPs, MTPs also, okay. What is important is in your exam conditions, if the paper is familiar to you, I think you will be able to sail through it, okay. And do not go for high levels of presentation like drawing lines, etc., etc. Okay, straight away at this stage, you know, you will not be marked for drawing lines for a balance sheet or for a ledger account. Okay, so you can avoid all those beautifications. If you have the time for that, you can do that, but it's not mandatory. You won't get extra marks for that. Neither will your marks be reduced. Okay, and try to write crisp. Write in your own words. Do not try to by heart anything as far as FR is concerned. It's purely a logical paper. So that is how you can improve. Okay. So it ensure that at least 90 to 95 marks you do attempt in the examination and come. Okay. It is a lengthy paper, no doubt about it. FR is a very lengthy paper. It also happens to be our most comfortable paper. So expectations on ourselves are also tremendously high. So therefore, you have to ensure that you have lot of practice under timely conditions. So typically, you can have a 14 to 16 mark question like preparation of a consolidated balance sheet. A 16 mark question, you can spend, let us say, about maximum 25 minutes. Okay, so if you go with these time restrictions, then I'm sure you will be able to settle yourself for the examination. Okay, all right. Scoring, yes, FR is obviously scoring, very scoring. Personally, for me, FR has always been my favorite. Okay. I did not attempt a large number of marks as far as I remember. Okay. Somewhere when I had answered almost what I answered, that much I got. Okay. Though I did not answer like 80 marks, 85 marks. I must have done about 70 to 73 marks and I got about 70 in the exam. Okay. So if you can ensure accuracy in your solutions, nothing like that. So you will be marked accordingly. Okay. So ensure that you be accurate in your answers. Try to solve as much as you can. Okay. Try to solve as much as you can. Okay. You will definitely be rewarded well for it. Okay. So FR is a very scoring paper. Definitely it is. And if your FR paper goes well, then what will happen is the other papers you automatically get confidence. Okay. It's just that the first pedal should be a forceful and a strong one so that it takes care of the other papers. Okay. You guys are really great. If I sit back today and if somebody tells me to answer a CA examination right now, I don't know how much I can answer. Okay. Those were student days when we were answering and somehow God was great. Everything went off very smoothly. Okay. All right. So let us now anyways continue. Don't have time. Okay. बात करते रहेंगे तो निकल जाएगा. ठीक है. All right. So that takes care of the question. As well as if it were an investment in equity, then what needed to be done, as well as if it is a gross settlement, what needed to be done. So the question per se is over, but now let us look at a couple of other things. Let us now look at, we will build up on this question only. See, Ind AS 109, IFRS 9, why they came was because you had to book the entries. You had to book the entries earlier under only when the net settlement or the gross settlement actually happened. In fact, under Ind AS 109, there is no concept of a contingent liability also. We will be studying, not today, maybe in the next class, items like financial guarantees, items like contingent consideration. These two particularly, financial guarantee is what? You have guaranteed a loan of another entity. In case that entity defaults, you will end up paying his loan to the bank. This is a guarantee. Under AS 29, this would go under a contingent liability because the accounting thought process was he has to default first. And for him to default, it is dependent on a condition which is not in my control. And therefore, why should I account it? However, Ind AS 109 even makes you record those financial guarantees in your books. Bolo, that kind of accounting we have started to move towards. Okay, it is not merely recording the transaction based on what has happened in the past. We are now trying to move towards an accounting where we get a possible peek into the future. Always people have joked about accountants, saying that you people live in the past. Aap history mein rehte ho. You don't live in the contemporary times and you certainly don't live in the future. Ind ASs have tried to break that image. Okay, Ind ASs have tried to break that image. We are trying to kind of bring in facets which enable us to look into the future, which enable us to view what is the possible impact that could happen in the future because of certain contracts. Okay, so if I'm certain about entering into a particular contract with a possible financial obligation or a financial right in the future, then Ind AS tells please record that. Okay, this was not there under the earlier IGAP regime. Okay, this was not there under the earlier IGAP regime. Okay, so that is the reason Ind ASs have been categorized as a superior set of standards. But here also I am not saying that this is perfect. Okay, there are lot of issues, lot of loopholes, lot of what you can say issues that need to be streamlined. It is a continuing process. Okay, Ind ASs are a continuing process. Reporting is a continuing process. Okay, and with the way the technology is evolving, the businesses are evolving, I'm sure that accounting also will evolve at a very fast pace, Okay, so now let us come to the next discussion. So you will be having all these accounts recorded at the time of entering into the transaction, even though there may not be a possible outflow right now. Okay, so हमें उसको account करना पड़ेगा. All right, now let us move on to the next one. In the question that we just now did, it was a forward contract. That means Samco was obligated to buy the dollars from JT Bank. Sam को बोलेगा मेरे को obligation क्यों चाहिए? I want an option to buy. If the price is in my favor, only then I will exercise the option. If the price is not in my favor, मैं exercise नहीं करूंगा. I will not exercise it. Okay, so that is the next concept we will discuss. Okay, this is extra part, case 1. Okay, now Samco, you can note this down because this is not there in the study mat. Okay, Samco and JT Bank. Okay, so now when we talk about Samco versus JT Bank, I have now entered into an option to buy. Earlier was a forward contract, option to buy $20,000 at rupees 68 per dollar on 31st December X1. Pays rupees 10,000 option premium on 1st Jan 20 X1. Pays rupees 10,000 option premium on 1st Jan 20X1. So this is the contract which you have now entered. See, option means what? Samco will say if the price on 31st December of the dollar is above 68, then I will exercise the option because it will be beneficial to me. On the contrary, if the price goes down, which it actually did in the question we just now saw, I will not exercise it. And if I do not exercise it, I will let the option, lapse. Okay. So now I want you to tell me, think and answer. Think and answer. Okay. If the contract is what is there in front of you, and on the settlement date, the dollar is 66 rupees. Okay, the dollar is trading at 66 rupees. You tell me, सोच समझ के जवाब दो. Pause and answer. You tell me what is going to be the maximum loss or maximum gain or minimum loss or minimum gain that I'm going to incur. What will be the outcome of this contract? जैसे we had found out 40,000 loss, you tell me what will be the final loss or gain that I am going to incur on this contract or that I am going to earn on this contract. Think and answer. Don't immediately jump to give me the answer. Okay, just think and answer. You have an option to buy. You are not forced to buy. Okay, you have an option to buy. It's not mandatory to buy. Okay. Absolutely right. I'm waiting for more answers, but Kaushiki got it right. What about the others? Janvi, tell me, what do you think? Tushar, tell me, what do you think? Namrata, tell me, what do you think? Okay. It is an option. It is an option. It is... Janvi is right. Namrata, what do you think? Viraj, what do you think? Vidit, what do you think? Tushar, आपको क्या लगता है? Yes. What is the loss or profit that one can earn on this contract? Rate is the same. On 31st December 20X1, rupees 66 per dollar. Okay, ये rate है. Okay. So now you tell me what is the loss on the contract. I have only changed the contract nature. That's it. Nothing else. Okay, come on, tell me. Namrata, tell. Viraj, bolo. Tushar, bolo. What is the loss on this contract? Yes, that's right. Tushar is right. Viraj is right. Vidit and Shubham, what is the loss on this contract? I need you to identify. I need you to identify ki bhaiya, what is the situation? How the contract works. So then accounting will not be very difficult for you. If we don't know the instrument, accounting will end up being difficult. Okay, Namrata, did you get the answer? If there is an option to buy, that is absolutely right. That is absolutely right. Contract will not be exercised. Both Namrata and Vidit, both of you gave the right answer. The option will not be exercised. And if the option is not exercised, you did not continue the statement. What will be my loss? Everybody gave my loss will be the option premium of 10,000. Are this is the, see, you are entering into a contract to buy the dollar. You are entering into an option to buy the dollar at rupees 68. That means you will buy only if it is favorable to you. So you have entered into a contract to exchange financial assets on potentially favorable conditions. It is an asset for you. It is a financial asset for you. You are exchanging financial assets on potentially favorable conditions. Yaad karo, definition of financial asset. We had discussed this point. If it is favorable condition for you, think the other way. JT Bank will be forced to sell the dollar to you at 68 no matter how high the price is. He has to buy from the market and give it to you. So he is under an obligation to exchange financial assets / liabilities under conditions potentially unfavorable to him. So JT Bank ke liye, if the conditions turn unfavorable, he will still be obligated to deliver a financial asset, in this case the dollars, to you. And therefore the contract is a financial liability. It is an obligation for him. So therefore for you, the loss is restricted to the option premium. Uska loss, there is no end to that. Okay. He will incur a huge loss. Suppose hypothetically the dollar goes from 66, 68, what we had contracted. Suppose the price of the dollar is 500 rupees for $1 as on 31st December. Aisa ho nahi, but suppose agar ho gaya, if it happens, then what will happen? If that happens, then he will collect only 68 from you, but he has to pay 500 and give you back. So that is ultimately his loss. There is no limit to his loss. For compensating him for that risk, we are paying something known as an option premium. Ultimately, he is a business guy. He knows that dollar is not going to rise. That is why he is willing to sell the option. You believe that dollar is going to rise. So therefore, because both of you think totally opposite, you can enter into an option contract. Nahi to kaun karega? If you also think it rises, he also thinks it rises, then nobody will agree for an option contract, because you will say, I want to buy. He will say, price increase, why should I sell you at a lower rate? Yes or no? So therefore, for an option contract, the buyer of the option will think differently. Diametrically opposite, the holder of the writer of the option thinks differently. However, they both join hands for executing this contract. Okay. So for the risk that the option writer bears, a payment, something known as option premium, is done. Okay. So now let us come to the journal entries. Okay. So is it a derivative contract? Yes. Underlying is there. Settlement at a future date. Insignificant value. Against 13 lakh 60,000 something, I'm paying only 10,000 today. So therefore, the initial payment is insignificant. So 1st Jan 20x1. What is the journal entry that you will pass? Bolo. I'm going to pay 10,000. Samco is going to pay 10,000. So to bank 10,000, this is the option premium. Whereas what will he debit? He can, earlier we used to debit option premium, that is the P&L item. Here what we will do is, we will debit derivative financial asset. We will debit derivative financial asset. Is it okay? So 10,000, 10,000. Any doubts? Any doubts so far? Yes. This is nothing but investment in option contract at fair value. At fair value. Are we clear with this? Are we clear with this? Are we clear? Okay, next. Okay, so now you are given the fair values. I'm keeping the same fair values. This will modify, but as of now, the same story continues. So under the earlier contract, the fair value was 25,000 loss, 15,000 loss, 12,000 gain. Okay, 12,000 gain. This is fair value forward contract. Okay, fair value under the forward contract. Now, fair value under the option contract. सोच के बोलो, ठीक है? The value of the dollar falls. Your forward contract value dropped by 25,000. Under an option contract, what is going to be the fair value of this option? Simple jawab dena. The value dropped by 25,000. And therefore, I booked a loss of 25,000. Now, under option contract, the dollar movement is the same. But now, what will be the fair value of the contract, the option contract? सोच के जवाब दो. Think and answer. Okay, it's not easy. Give a little stress on your head. Okay, what will be the fair value of this option? Okay. Jahnavi, what do you think, beta? What do you think? Socho. Think from the perspective of Samco. I'm in the books of Samco. Think from the perspective of Samco. Samco has an option contract. The price of the dollar has gone down. And because the price of the dollar has gone down, whether Samco will exercise this option. Tell me whether Samco will exercise this option on 31st March 20x4. Whether Samco will exercise this option on 31st March 20x1. Not 4, 20x1. सोच के जवाब दो. Will this option be exercised? No. Your price of the dollar in the market has gone down. So your contract versus the price of the dollar, there is a gap of 25,000 rupees. There is a gap of 25,000 rupees. The piece of paper, the forward contract that you are holding, has eroded value and it is currently at a negative fair value of 25,000. Are we clear about this? Yes. But if it were to be an option contract, you have an option contract, the price of the dollar in the spot market is gone down. The price has gone down. And if the price has gone down, will you exercise the contract? Answer is no. So if you will not exercise the contract, your value option has no value at all. वो बस एक paper है. Okay. This paper which is there in my hand, has no value. Why no value? Because it is a mere piece of paper having no relevance due to the dollar rates falling. And therefore, though the fair value of the forward contract was negative, it was negative because you were obligated to buy. Are you able to follow? In a forward contract, आपके पास option नहीं है. Suppose instead of 68, the dollar became 20 rupees. You still had to pay 68. Are you able to follow? You still had to pay 68. And that is why you are under an obligation there. And that is why the fair value is 25,000 negative. But here under an option contract, you have an option not to exercise it. Yes or no? And if I have an option not to exercise, the piece of paper, which is the option contract, clearly has no value. The value of this option becomes 0. The value of this option becomes 0. I will not exercise the contract. I have the option, and under the option, मैं उसे exercise ही नहीं करूंगा. And when I don't exercise, what will be the value for me? See, the value for me for that option is 0. You go to anybody in the market and try to sell that option. See, spot rate is 66.75. The contracted rate is 68. You try to sell this option in the market. Do you think anybody will pay you for it? They will not pay you. बोलेंगे नहीं चाहिए हमें तुम्हारा contract. Okay? Because your dollar price is falling down. And even if they take it, they will say ऐसे ही दे दो. हम कुछ नहीं देंगे because it is an option to buy. It is an option to buy. So therefore, the price is nil. The fair value is 0. Why it is 0? As option holder won't exercise. It is a case of a loss. Is everybody convinced about it? Is everybody convinced about it? Yes or no? Is everybody convinced about it? Janvi, samjha beta, Vidit, are you now sure? You were on the right thought process. It will be 0 or 10,000. You were almost there. Not sure. Okay. Namrata is clear. Yes. Janvi, it cannot be a -15. Tushar also had given the same answer. Yes. Are we able to follow? Yes. Sure. Okay. Good. So now, as on 31st March, I have to recognize a loss of 10,000. Sir, loss abhi to bola incur nahi karoge. Nahi karenge. But I have a derivative financial asset whose fair value has become nil just now. As on the date of the contract, I booked 10,000 because that was the transaction price, which is the fair value. Now the fair value of that contract has become 0. So मैं कितना book करूंगा? I'll just reverse that derivative financial asset of 10,000. Sir, why not 25,000? Array, value is nil. Option value is nil. You will not exercise the option. So your loss at any point of time will be limited to 10,000. Okay. So therefore, I will pass the entry now. Fair value loss. P&L debit 10,000 to derivative financial asset 10,000. We will not even recognize a liability. There will be some students who will say, Acha, so we have to recognize an obligation, no? Because what 25,000 ho gaya. So we will make this 15 and we will make this 25,000. No. An option contract represents a right to exchange assets under conditions potentially favorable. Here it is not potentially favorable. You will not exchange only. You are in a commanding position. So therefore you will not exercise this option. You will not create any obligation because you are not obligated to exercise it. Okay. You are not obligated to exercise it. Any contract is always, any option contract, not only this one, any option contract is always good for the buyer. Always. Likh ke le lo, it is always good for the buyer. Let's take another case, extension of this question, where Sam company writes an option allowing JT Bank to sell the dollars. There the story will become totally different. Okay, there the story will become totally different. Okay, why we have recorded derivative financial asset? Okay, couple of reasons. First one is, it is not going to be treated as an expense. Why? Because the life of the option is over 1 year. The life of the option is a 1 year period. So each period, each reporting period, I can book a loss or a gain. If I had to record it as an expense on the first day, then what would happen is Q2, Q3, Q4 expense aata nahi tha. So here, if I record a derivative financial asset and take the option movements, the fair value movements for each period, that makes infinitely more sense. So that is why we don't recognize it as an option period, as an option premium expense. We will take it as a financial asset, number one. Second one, this derivative contract gives us the indication that we are having a derivative in our balance sheet. If we take it as option premium, the derivative financial asset will not be visible on the face of the balance sheet, which could end up confusing the readers. Readers will see option premium is there, but where is the option? Option jayega kahin pe under the notes to accounts, क्योंकि option will not be disclosed on 1st January 20X1. So that is why we have to show derivative financial asset. So you will be having financial asset in the balance sheet and all the fair value movements through the profit and loss account. Is it okay with you? Yes. So that takes care. So you can also you can take it back as another reason why we book a financial asset is it is a financial asset. Ultimately, either you exercise and get your other contract, in which case it will amount to a disposal of the option and collecting the proceeds. Okay, so that is how we'll be viewing the contract. Don't view it as income expense. It's difficult because under AS we used to treat option premium as expense or as income. Yahan pe waisa nahi hai. It will be a financial asset. We will book the gain or loss as an outcome of the proceeds, as an outcome of the proceeds of the financial asset disposal. Is it okay? Yes. All right. Now let us move on to 30th of June. Let us now move on to 30th of June. Okay. Now think. Fair value of the contract is 15,000 for a forward contract, negative. What will be the fair value of the option for you? What will be the fair value of the option? Sir, here also same thought process, nil. So therefore, reason being, I won't exercise. I am having a 15,000 potential loss. So make you exercise karu. If I exercise the option, I'll suffer a loss of another 15,000. So isse acha hai bhai, I won't exercise. If I won't exercise, the worth of that paper is zero. The value of that paper is zero. And therefore, the fair value of the option is nil. The fair value of the option is nil. Now tell me, what will be the entry that you are going to pass on 30th of June? Kaushiki, did you follow the discussion why it is a derivative asset and not option premium? Yes. Others, please tell me on 30th June, what is the journal entry that we will be passing? What is the journal entry that we are going to pass? Absolutely right, Janvi. Yes. Absolutely right. Namrata, tell me, Viraj, tell me, what is the entry that we will be passing on this date? What is the entry on 30th of June? Socho, derivative financial asset. What is the value as on date? What is the fair value as on date? And therefore, what is the entry that you have to pass? Think it in that manner. Will you pass an entry? Answer is no. No entry. Why no entry? Fair value is 0. My derivative financial asset is already appearing at 0. 10,000 minus 10,000. So the 10,000 minus 10,000. It's already appearing at 0. So और क्या करने का? I don't have to do anything. So therefore no entry. Okay. Therefore no entry. I haven't yet come to 12,000. I haven't yet come to 12,000. Okay. अभी हम लोग वो 15,000 वाले में ही हैं. Okay. So therefore no entry. Why? As fair value of financial asset is already nil. As fair value of financial asset is already nil. Okay. Absolutely right. Okay. You guys are brilliant. Okay. So 30th September 20x1. The fair value of the forward contract is now positive 12,000. So dollar rates have increased. Your contract becomes valuable now. So what will be the fair value for you as an option holder? सोच के जवाब दो. Think and answer. What will be the value? What will be the value of the option holder? Oh, sorry. What will be the value for you as an option holder? As an option holder, will it be 0? No. If dollar rates go up, I will be the first person to stand in queue and say, le beta, mera option le, give me the money back. So for you also, the fair value of the option is 12,000. Why will it be 12,000? You will now exercise the option. You are now going to exercise the option. Yes or no? So therefore, here we will say that as exercising option is profitable. As exercising option is profitable. That's right. That's right. Okay. So what is the entry that I'm going to pass? The entry that I'm now going to pass is recognizing a derivative financial asset and recognizing a fair value gain of how much? Entire 12,000. Entire 12,000. So this is going to be derivative financial asset debit 12,000 to fair value gain P&L 12,000. Okay. Absolutely right. 10,000 is Kaushiki. Don't look it like that. See, that is why I have avoided recording option premium as a P&L item. Okay. So 10,000 derivative financial asset, it is getting de-recognized here. Okay. So 10,000, 10,000. So derivative financial asset is not there. Okay. All right. Okay. So Janvi has a question. Janvi has a question. If the fair value of the option is 12,000 on 31st March 20x1. If fair value of the option on 31st March 20x1 is 12,000, I have what you can say, I have a gain to the extent of 2,000, which is possible. So therefore, you will pass the entry derivative financial asset account debit 2,000 to fair value gain or loss 2000. So I will restate it to 2000. Suppose 31st March X1, the value is 4000. Fair value is 4000. I will have to write down my derivative financial asset. I will have to write down and bring it to fair value. Okay. So therefore, that point of time, it will be a fair value loss of how much? 10 minus 4, 6000. You can have a loss up to 10,000. See, the principle is very simple in an option contract. Up to 10,000 loss, book karo. Beyond 10,000, you should get red lights flashing in front of you. 10,000 के ऊपर नहीं हो सकता हमारा loss. Okay. So you should have red lights flashing in front of you. All right. Okay. Fine. So that takes care of Jahnavi's question. Yes. See, just I'm deviating to answer Jahnavi's question. She is asking 31st March 20x1. Suppose fair value is equal to 4000. Initially, I have recognized a derivative financial asset appearing at 10,000 debit. So now the fair value is 4000. So I will pass the entry fair value loss P&L debit 6000 to derivative financial asset 6000. Simple mark to market entries. There is no confusion at all. Okay. There is no confusion at all. Okay. Okay. Up to 10,000, any loss you can recognize. Okay. Because here also, you will end up thinking rationally and say that, why should I allow the option to lapse? I'm at least getting 4,000. My loss will be reduced by 6,000, by 4,000 rupees. Okay. It will be restricted to 6,000. So let me record this. I will definitely sell if the asset fetches me 4,000 rupees net on a settlement. Okay. Are you clear, Jahnavi? Yes. So done. I'll just rub this off now. Okay, so let us rub this off. Not getting an answer. Okay, fine. So that takes care of her question. Next one, 31st December 20x1. Okay. Now on 31st December 20x1, on 31st December 20x1, actual spot rate is going to come. Actual spot rate is going to come, which is rupees 66 per dollar, which is rupees 66 per dollar. Okay. Okay. Now tell me 31st December, what are you going to do? 31st December, क्या करोगे? You have an option to buy the dollar at 68, at rupees 68 per USD, whereas the spot price is rupees 66. Think and answer, what am I going to do? What am I going to do? What am I going to do? बोलो बोलो, क्या करोगे आप? You will not exercise the option, correct? So exercise entry, will it come? Answer is no. So therefore, no exercise entry. But there is one entry which you will pass. Sir, kaun sa? Bolo, you tell me. This 10,000 got cancelled. And now we are having this 12,000. So this 12,000, I will have to reverse it. So derivative asset will be written off. So therefore, 1 second. As option won't be exercised. As option won't be exercised. Absolutely right. So therefore, the last entry will be write off the derivative financial asset. So the entry will be fair value loss P&L debit to derivative financial asset. 12,000 to derivative financial asset 12,000. Okay, so now let us look at our P&L. All of you said that a 31st March loss, 30th June no entry, 30th September 12,000. No entry. 30th September 20x1. I have booked 12,000 gain. And 31st December 20x1. 12,000 के बाद I have written off 12,000. So the total comes to how much? 10,000. This is for 20x1. And what is this 10,000? This is the maximum loss that you can be incurring on the contract. This is the maximum loss that you can be incurring on the contract. Are we clear with this? Yes. So is it in line with our understanding of option principles? Yes, it is. Is it clear, everyone? Yes, Kaushiki. Janvi, is it clear? Vidit has confirmed. Viraj, is it clear? Tushar, is it okay? Namrata, is it fine? Okay, so that concludes our discussion on option contract. Yes, that concludes our discussion on if it were to be an option contract in place of forward contract. Okay. We take a last case scenario. Everybody has noted this down. Yes. So now we take a last scenario. Case 2. Samco, JT Bank have entered into a contract, and as per the contract, Samco agrees to sell an option. So option buyer, option writer. I'll give a break once this is done. Okay. It won't take more than 10-15 minutes. Okay. Once this is done, it comes to a final conclusion. So then you can take a break. Okay. So Samco and JT Bank have entered into a contract where they have agreed to exchange as an option the dollars. Okay. So option to sell $20,000 at rupees 68 per dollar. At rupees 68 per dollar on 31/3/20x1. Option premium 10,000. Option premium 10,000. Yes, journal entries. We are in the books of Samco. We are in the books of Samco. आपको ब्रेक की जरूरत लगती है क्या? Are you feeling the need for a break? मुझे तो कभी नहीं लगती. Oh, you can tell me to go on for 5-6 hours also without a break. I think I can do it. Okay. So 1st Jan 20x1, Samco receives the premium. So bank account debit to derivative financial liability 10,000. Samsung is selling the option. JT Bank is buying the option. So the entry will be bank account debit to derivative financial liability 10,000. This is an obligation on Samco to deliver financial assets under potentially unfavorable conditions. Under potentially unfavorable conditions. And therefore, it's a liability. Okay. All right. Date 30th June, 31st March, 30th September, 31st December. All right, fine. Then we are having a fair value for the forward contract. 25, 15, 12, and here spot rate 66 per dollar. Next. Okay. Fair value forward, spot rate 66 per dollar. Fair value option contract. Now I want you to think again. Zara socho. You are the option seller now. Okay. JT Bank is the option buyer. JT Bank is the option buyer. सोच के जवाब देना. Don't hurry. Pause. Okay. Stop karo, socho, and then jawab do. The dollar rates have come down on 30th of June. The dollar rates have come down on 30th of June. On 30th of June, the dollar rate, I'm giving that crude example which I explained to you earlier. The dollar rate is 66.75, right? is 66.75. The contracted rate is 68 per dollar. Okay. No. Think and answer. Think and answer, Kaushiki. Don't run to give an answer. Okay. Think and answer. Okay. Minus 68. Okay. So, will this option be exercised? Will this option be exercised? You are in the books of Samco. Will Samco exercise the option? Will Samco exercise the option? यही तो गलत है. This is what you are making a mistake, everyone, my friends. यहां पे Samco is not the one who will decide. Samco ने तो ऑप्शन बेच दिया. Samco sold the option. Who is the one who will decide? JT Bank is the one who will decide. Samco उसके इशारों पे he will do the accounting. You don't think from the perspective of Samco now. Is this contract favorable to JT Bank? Is this contract favorable with JT Bank? No. Yes, it is favorable. Bahar mein the dollars are running at 66.75. Your contract is enabling JT Bank to sell it to you for 68. Is JT Bank going to exercise the option? Answer is very well yes, JT Bank will exercise the option. If JT Bank exercises the option, is Sam company obligated to accept the exercise? Answer is yes, because the option lies with JT Bank. Option does not lie with Samco. And therefore, will this option be exercised by JT? Yes. So will it result in an obligation for Samco? Answer is yes. What will be the value of that? The value of that will be 25,000. Negative. Are we clear with this? I was afraid of you guys making this mistake, and I'm very happy that you made this mistake. This is the first and last time you will make this mistake here. Iske baad you will never make this mistake. Okay? Never will you make this mistake. Okay? JT has the option to decide, not Samco. Samco has sold the option. This is exact opposite of case 1. This is exact opposite where Samco was in the... Okay, repeat again. All right. Fine. Understand. On 30th of June, I'm giving a simple case. Okay. On 30th of June, the price of the dollar in the spot market came to 66.75. But you have given an option to JT Bank to sell the dollar. Okay. See, look at the words. Look at the words. Look at the words. Option to sell. And here look at the words. Option to buy. So here, in this case, Samco has given JT Bank an option to sell. So therefore, JT Bank on 30th of June will look at the contract. Contract rate is 68. Market rate is 66 point something. So what JT Bank will say, yeah, it's beneficial if I exercise this option. So if I exercise this option, what I will have to do is, I will have to sell this dollars to Samco for how much? 68. Do you think JT will exercise? Answer is yes, he will. Because JT Bank is now having the option. Samco does not have the option. Samco ne to option becha hai. Samsung sold the option. Sir, if in the previous case Samco bought the option, Samco bought the option, so the loss of Samco was limited to 10,000. But in this case, whatever be the market price, suppose hypothetically, the price of the dollar is $1 for 1 rupee. That means what? Samco is staring at 67 rupees per dollar loss. Will it incur that loss? Definitely. There is no limit. There is no limit to the loss that Samco will incur. There is a limit to the loss JT Bank will incur. But we are not in the books of JT Bank. We are in the books of Samco. So in the books of Samco, will JT Bank exercise this option now? Answer is yes. The option is with JT Bank. Whatever JT Bank does, Samco is obligated to follow. So look at the words of financial liability. A contract where you agree to exchange financial assets or financial liabilities under potentially unfavorable terms. Is it an unfavorable term for Samco? Yes, because he will do whatever he wants so that JT Bank ends up getting benefited. So this is a potentially unfavorable situation for Samco. For JT Bank, it is a potentially favorable situation. So for JT Bank, it will end up being an asset. For Samco, it will end up being a liability. Is it okay? Yes, it is mandatory. Same case here. Whenever the price of whenever the price moves in favor of Samco, JT Bank has to agree to it. Why? Because the contract is such. You are comfortable with seeing an option to buy. It's just a perspective issue. Otherwise, fundamentally, you guys are not wrong. You gave me the right option here. It is just that we have done a mirror image of the question. Thoda time lagega, but you will get it. Okay. In this case, Samco had the option because Samco purchased the option. In this case, JT Bank has the option. Sam ke paas option nahi hai. Sam will do whatever JT Bank tells it to do. That's it. Nothing else. Okay. So now, see, it is not a contract to buy. Look at the words. It is an option to sell. It is an option to sell, Jahnavi. It is not an option to buy. JT Bank has an option to sell the dollars. JT Bank has an option to sell. Look at the words. Itne chote se word mein institute can give you a problem. Read the question with 10-15 times you read the question to understand. Here Samco had an option to buy. In this case, Samco is selling an option to Reliance. Yes, and you enter into an option contract with me that suppose I will buy for you at 2000 is the price. If so, this is an option. I will buy at 2000. Now, when the price goes to 3000, you will exercise. I have to give it to you for 2000. If it goes below, you will not exercise. I still have to keep quiet. Is it okay? Because I don't have an option. I sold the option to you. You have kept the option with yourself. Okay, you bought the option and you are now exercising that option. You are now exercising that option. Is it okay? Yes. All clear? Interesting? Yes. Is it interesting? So on 31st March 20x1. Basically, what you are doing is in this question is you are giving a risk protection to JT Bank. You are protecting JT Bank because whatever be the fluctuation in the dollar, 68 per dollar is the guaranteed amount that JT Bank will get. Okay, 68 per dollar is the guaranteed amount that JT Bank will get. Okay, so now 31st March 20x1, the fair value is 25. You already have liability appearing at 10,000. So we will recognize another 15,000. Fair value loss, P&L debit, 15,000 to derivative financial liability, 15,000. Okay. This is 25,000 minus 15,000. Great, great, good. You tell me now, 31st March 20x1, 31st March 20x1. What will be the fair value of this option? What will be the fair value of this option? सोचो, सोच के जवाब दो. Think and answer. Okay. Don't jump to give me the answer. I'm not in a hurry. You may be in a hurry. Okay. I'm certainly not in a hurry. It's 9:30. My God. आज तो पढ़ाते पढ़ाते पता ही नहीं चला. I was thinking it is 8:45. मेरा घड़ी अटक गया इधर. Okay. 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 All right. Fine. Fine. Good. Good. I'm sorry. I should have given a break. I now realize it. Okay. Fair value of the option is 15,000. Absolutely right. Okay. Correct. So now 31st March. Sorry, not 31st March, 30th June. So what is the entry that I'm going to pass? The entry that I'm going to pass will be option. The liability is at 25,000. It has to become 15. So derivative financial liability debit 10,000 to fair value gain 10,000. 10,000. 10,000. This is 15 minus 25. Here is a mistake. It should be 25 minus 10. Okay. All right. Fine. Excellent. Okay. All right. This is the last time I'm troubling you. Okay. The last time I'm troubling you, or second last time. Okay. 30th September, fair value is positive 12,000 for the forward contract. What will be the fair value for the option contract? सोच के जवाब दो. Think and answer. What will be the fair value on 30th September for the contract? What will be the fair value on 30th September for the contract? It is positive 12,000. Think and answer. Don't rush to answer. Think it in this manner. Think it like this. In terms of this, you will get your answer. Think it in these terms. I will not tell you the answer. Everybody should give me the right answer. Kaushiki gave the right answer already. Jahnavi, Namrata, Vidit, Viraj, Tushar, Shubham, if he is there. Yes? Think and answer. Just soch ke jawab do. It's very simple. Okay? It's very simple. Think and answer. Okay? Think it from, it says 12,000 positive, it's not negative. So there is a difference. Okay? So soch ke jawab do. It's 12,000 positive. Think. Socho. Yes. Viraj is also right. See, think it off like this. Earlier, it was a positive forward, in the forward contract where Samco was the buyer, it was a positive fair value. It was a positive fair value. That means what? That means the contracted price, option price is rupees 68 per dollar. Whereas I again do the crude option way that I explained to you. 68 into 20,000 plus 12. That means spot rate is 68.6 per dollar. If you do this, I get a positive fair value of 12,000. I get a positive fair value of 12,000. So now you tell me JT Bank has this option to sell the dollar at 68 rupees, but the spot rate is 68.6. But the spot rate is 68.6. JT Bank has contracted to sell the dollars to Sam at 68, to sell the contract at 68. Namrata is right. Namrata, you are right. Okay, absolutely right. Okay. So JT Bank has an option to sell at 68, but the spot rate is 68.6. Think it off like this. Okay. It is not such a straightforward working, but I'm trying to explain the feature to you. Versus 68 to 68.6, what will JT Bank do? Will it exercise the option and sell it to you at 68? Or will it sell it in the market for 68.6? Sir, it will sell in the market for 68.6. If it sells in the market for 68.6, will it exercise the option? Answer is no. It is letting the option to lapse. And if it is letting the option to lapse, what will be the value of this option? It is going to be nil. It is going to be nil. Why? Because JT Bank is not exercising this option. Why it will not exercise? Are spot market में the rate is higher. For JT Bank it is option to sell. वो डॉलर बेचेगा आपको, तो आपके पास नहीं आएगा बेचने के लिए. You are Sam को, you cannot force him and tell दे दे मेरे को $68 में. It is his option. It is not an obligation for him. For you, it will be an obligation provided he exercises. जब वो exercise करेगा ही नहीं, it is not an obligation for you. Fair value of option is 0. Is it clear, everyone? Yes. Is it clear? Yes or no? Bolo. Tell me. Janvi, did you get it, bacha? Yes. Vidit, so you said nil and you said not sure. So not sure में से not हटा देंगे. So are you sure that it should be 0 now? Tushar, did you follow? बात समझ में आ गई बच्चा आपको? Yes. Viraj, is it clear? Viraj gave the right answer. Yes. Are we able to follow? I many times lament the fact that I don't get to see you face to face. Though technology has brought us closer to exchange our thoughts sitting at the comfort of our homes, there is a magic that happens in a classroom. Okay, because when the teacher looks at the student's eyes, the student looks at the teacher in the eyes, that point of time when the student understands, that is literally a moment of magic for any teacher who stands on the platform and teaches. Okay. So therefore, that is something which we are unfortunately missing out. Okay. That is something we are unfortunately missing out. Doesn't matter. You have more than done to mitigate that distance with the interaction that you have given to me. I'm really grateful for that. Okay. So that is it with it. That's right. Okay. You don't have to worry. See, come on. You ultimately have to be confident. Okay. So the value is 0. And therefore, let us now proceed to pass the journal entry. 30th September 20x1. What will be the entry? The entry is going to be removal of the liability in entirety. Derivative financial liability debit. It's appearing at what? 10,000 plus 15, 25 minus 10. So we will remove it in totality. 15,000 into fair value gain, P and L, 15,000. Is it okay? Yes. The financial liability has come to zero now. इसी को बोलते mark to market. We call it as mark to market. Okay. Janvi, did you understand, bacha? Yes. Namrata gave the right answer. Kaushiki was also correct. Viraj was also right. You make a mistake here, 100 times I will explain. Okay. But don't make a mistake in the exam. Okay. In the exam, read once, twice, thrice, 4 times, 5 times if you want. But when you hit it, you should hit the question with a bullseye. Okay. No, I'm not a paper checker. We are not permitted. Okay. When we teach you, as per the institute's guidelines, we cannot become paper checkers. Okay. So that is not permitted. Otherwise, I don't know. Okay. There could be a conflict of interest. Okay. All right. So coming to 31st December. 31st December settlement. 31st December settlement. Tell me, will the contract be exercised? Will the option be exercised by JT Bank? Just give me this one answer, yes or no, then we'll proceed to do the accounting and close it once and for all. Okay. Will JT Bank proceed to exercise this? It will exercise and sell at 68. Absolutely. It will exercise and sell at 68. Perfect. So now I will do both the settlements for you. Chalo. आपके लिए ये कर ही सकते हैं. Gross settlement, net settlement. ठीक है. So therefore, in gross settlement, JT will sell it to Samco for 68. That means Samco will be paying at the rate of 68. I am in the books of Samco. वो मत भूलना. Okay. I am in the books of Samco. So this will be $20,000 into rupees 68 per dollar. उसने exercise किया. That is why I have to pay 68. That is why I have to pay 68. He has exercised. So therefore, I will pay 68. मेरी मजबूरी वो फायदा उठा रहा है. Okay, 13,60,000 I will pay. What am I getting? Sir, I am also getting dollars. वो dollar कहाँ आ रहा है? It's coming in my bank account. So bank account debit. How much? You are getting something which is worth 66 spot rate. Okay, you are getting something which is worth 66. So therefore, this is going to be $20,000 into rupees 66 per dollar. So this is 13,20,000. This is 13,20,000. So difference कहाँ जाएगा? 40,000. This is the extra amount you had to pay because you have agreed to buy at 68. जबकि spot rate में you would have bought it at 66. So that is a loss which you are incurring. So loss on settlement or fair value loss. Call it anything. Okay. P and L. Okay. Yes. Acha, net settlement also is possible. Samco will tell, look, you will give me dollars for which I have to pay you 68. The dollars are actually running 66 in the spot market. So what I will do is I will pay you net 2 rupees per dollar. इसी को बोलते हैं net settlement. Yes. So I will pay net settlement to bank $20,000 into contracted rate was 68 per dollar. Spot rate is 66 per dollar into 20,000. So this comes to 40,000 and whole thing is your loss. Whole thing is your loss, 40,000. So again, see, I had told you loss should be the same. Whether it is gross settled or net settled doesn't matter. Loss on settlement, P&L. Doesn't matter what method of settlement you use, it should be the same. Mandatory hai wo. You are just changing the mechanisms of exchanging the money, but otherwise the final position should remain the same. Okay. All right. Everybody understood? Yes. Yes. Are we clear with the question? Yes, Janvi, Kaushiki, Namrata, विदित आएंगे, मौका मिलेगा, किसी ने बुलाया तो जरूर आएंगे. Yes, Tushar, is it okay? Viraj, is it fine? Yes. Everyone, is it clear? Understood. Okay. Namrata, is it okay? Yes. All right. Now, don't look at journal entries. Don't look at journal entries. What will be the total loss that Samco is incurring on this contract? Don't look at journal entries. I want to see whether you have understood the concept or not. What is the total loss incurred by Samco Limited on this contract? But आप लोग सोचते नहीं हो. जर्नल एंट्री मत देखो, कंसेप्ट लगाओ. जस्ट पुट योर कंसेप्ट, पुट योर ब्रेन्स ऑन द जॉब. 40,000 नहीं होगा वो, इट इज 30,000. स्टार्टिंग में 10,000 का ऑप्शन प्रीमियम दिया है ना. अरे हैज ही गिवन द ऑप्शन प्रीमियम टू मी? सैमको हैज रिसीव 10,000 ऑन सेटलमेंट 40,000. सो नेट लॉस कितना होगा? इट विल बी 30,000. नो सर, बट 10,000 P&L में नहीं जाता है. अग्रीड, बट इफ यू लुक एट द स्कीम ऑफ एंट्रीज, वो 10,000 ultimately is going to the P&L at some point of or the other. Okay. So therefore, your net loss will be the loss on settlement date minus whatever option premium you would have collected. Minus whatever option premium you would have collected. Sir, test कर लो, proof बताइए, proof. Okay. तो proof भी देख लेंगे. Yes, we will check the proof also. Yes. तो एक बार proof करेंगे. So P&L account debit. P&L में देखते हैं 1st Jan 20X1 0. Next one 31st March 20X1 15,000 loss. Here only that 10,000 has gone. See, the loss was 25. But I have booked the fair value loss, negative is 25, but I have booked a loss of 15 only. So yahi pe that 10,000 has been adjusted. Okay. Then 30th June 20X1. There is a fair value gain 10,000. 30th 9 September. There is another gain of 15,000. And finally, 31st December X1, 40,000 का loss है. So total for 20X1 is 15 get cancelled. I am left with 30,000. I am left with 30,000. Are we clear with this? और कुछ केस बचा है डेरिवेटिव में. We saw option buyer के बुक्स में, we saw option seller के बुक्स में, and we saw forward contract. बचता एक है, that is futures. Futures and forward, no change. Whatever we did in forward, the same thought process, same journal entries will follow for a futures contract also. The same entries, same, everything same will follow for a futures contract as well. Are we clear with this? Yes, sure. Enjoyed derivatives? Yes. Okay. All right. We take a 10-minute break. I will continue till 10:30, 10:45. Okay. Please bear with me. I want to do a couple of things more with you. Okay. So this question is done. So as far as derivative accounting is concerned, we are through. Okay. But there are small issues in derivatives, which I will now be covering. Okay. So we take a 10-minute break. And once we complete, we return after a 10-minute break, another half an hour to 40 minutes, I will just cover 1 or 2 topics and then we wind up the class. Okay. All right then. See you in 10 minutes. Okay. Right. So let us continue with our discussion on derivatives. Okay. So there is a fairly new concept. Okay. I won't say it's new per se, but for you it would be new. Okay. So there is something known as equity derivatives. Okay. Which you already know that it is when you are dealing with your own equity instruments, they become equity derivatives. We have all studied equity derivatives. कहाँ पढ़ा है सर हमने? When we did compound financial instruments, what is compound financial instruments? You are issuing a debenture that has an option to convert. And whom are you giving that option to convert? To the holder of the instrument. And when you give the option to convert, ultimately the transaction is getting settled in the entity's own equity instruments. Are you aware about this? Yes. You are able to remember this. I can give you two instances where we have done equity derivatives. Okay. One is, of course, compound financial instruments. The other one is share-based payments. What do you do in share-based payments? You give your employees the option to subscribe to your shares. So it is for a fixed number of shares for a fixed price. Exercise price is fixed. Number of shares is fixed. So fixed for fixed ho gaya. You have given an option. Is it a derivative? Yes. Why? Because first one, is the value dependent on an underlying? Yes, the entity's own equity shares. Second one is it going to be settled in the future? Yes. Does it require initial payment of a significant amount? No. And therefore, an ESOP also meets the definition of an equity derivative. Same for the compound financial instrument also. Okay, it is a mix, but the equity component, which is the convertible one, that is a derivative. Now, these two components you have studied. But in these two components, the case was you were the entity issuing the shares. Are you able to follow? You were the entity issuing the shares. Okay. So can I have a reverse situation? Can I have a reverse situation where I am giving an option to an entity who is already holding my equity instruments to sell it back to me? Are you following the change? Okay, so this is equity derivatives. With an obligation to deliver cash. With an obligation to deliver cash. Okay, see, this is like, let us suppose, how do I write it? Okay, fine. Let us take an example. Suppose I have a company A Limited. I have another company B Limited. Okay. B Limited holds shares of A Limited. Holds shares of A Limited. So basically, under this concept, A Limited enters into a contract with B Limited. Suno zara dhyan se, you will understand the concept, it won't be difficult. So therefore, on this date, A gives option to B. Okay. And what is the option? To sell equity shares of A for rupees. Kitna lenge for example? Okay. For 440 crores. Okay. So this is the shares which B Limited is holding. So to sell equity shares. Okay. I will make it more simple. To sell fixed number of equity shares for 440 crores. Are we clear with this? So basically, fixed number and fixed price. So can I say that it is passing the fixed for fixed test? Yes or no? So in other words, is this contract going to be an equity contract? Bolo, is this contract going to be an equity contract? Yes, because it passes the fixed for fixed test. Okay. To sell fixed number of shares of A for 440 crores after 2 years. After 2 years. Pehle suno, then I'll make you write down something and then you can copy the solution. Okay. Sell fixed number of equity shares of A for rupees for 440 crore after 2 years. Okay. Now, option premium is equal to rupees 50. Option premium is equal to rupees कितना रखेंगे 15 crores. Okay. Option premium is rupees 15 crores. Okay. So this is the contract which is there. This is the contract which is there. Now, okay. So it meets the definition of a derivative. So is it a derivative? The first question. First one. Underlying, yes. The option derives value from shares of A Limited. Settled in future, answer is yes. After 2 years. And third one, initial payment, insignificant. You may think that 15 crore itna bada amount hai. In front of 440 crore, it is nothing. Okay. It is not even 10%. Okay. As far as I know, it is not even 5%. Okay. So it is insignificant. You may feel that 15 crore is a huge amount. It isn't. Okay. So now it is a derivative. Therefore, derivative. Okay. For A Limited, this will be a contract where there is a return of equity shares, where there is a return of own equity instruments. So therefore, what entry A Limited will pass? Year 0. Bank account debit, 15 crores. 2. Can I say that this one is going to be a derivative equity, or is it going to be a derivative financial liability? Sir, derivative equity hai here. For A Limited, this is 1 second. Journal A Limited. Okay. Bank account debit 15. 2. Is it a derivative for A? Yes. Financial asset? No. Financial liability? No. Equity? Yes. So therefore, this will be to other equity. Into bracket, put option. Into bracket, put option. Okay. Basically, what A is doing is, A is selling a put option to B. A is selling a put option to B. So A is a writer of option. Option seller जो option बेचता, A is like Samco Limited in the last case, and B Limited is like JT Bank. So this is the option buyer बोल सकते हो या option holder बोल सकते हो. Okay, buyer or holder. Okay. So this is what is the transaction. As far as B Limited is concerned, is it a derivative contract? Yes. For B Limited, it could be a financial asset or a financial liability depending on price movements of A Limited shares. Okay. But basically, it will turn out to be an asset because it is an option contract. It is an option contract. Okay. So option to exchange financial assets or liabilities at potentially favorable conditions. At potentially favorable conditions. So ये हो गया मेरा story of the contract and the first journal entry on year 0. Bank account debit to other equity. अच्छा. Now, this is other equity. इस पे जरा ध्यान दो. This is other equity. So when I say other equity, this particular portion, there won't be any remeasurement. This is not having any remeasurement permitted. There won't be any remeasurement that will happen. Are we clear with this? Yes, because it is a derivative equity, and equity is never remeasured. Never remeasured. Okay. Is it okay? Yes. Are we fine with this? Everyone? Namrata, Viraj, Tushar. Pata nahi. Ask. I mean, I don't know. Anything is fine. I didn't know that we had CA Students Association representatives here. Yes, but it's interesting. Okay. All right. Boliye. Is it clear? Yes. So now let us move to the next step. Let us now move on to the next step discussion. Is only this enough, or am I missing out on something? Equity derivative I accounted. Yes, sir. बस हो गया ना फिर, तो और क्या करना है? Am I missing out on something? Am I missing out on something? Yes. कुछ छूट रहा है क्या मेरा? As on the year 0, ये एंट्री तो पास होगी. Bank account, I got the money. Is anything left out? Is anything left out, or we just stop here? हो गया मेरा काम खत्म, मुझे कुछ नहीं करना अभी. नाइदर हमें रीमेजरमेंट करना है ना हमें कुछ करना है. दिस इज जस्ट एन इक्विटी डेरिवेटिव. पैसे मिल गया, बाद में सेटलमेंट के टाइम पे हम लोग देख लेंगे. इज दैट व्हाट वी विल इंप्लाई, और इज देयर समथिंग आई नीड टू डू? इज देयर समथिंग आई नीड टू डू? The question is, we need to book 440 crores, not because 15 is insignificant. We need to record the potential obligation of 440 crore. We need to record the potential obligation of 440 crore. Why? Because tomorrow if B Limited exercises the option, A Limited has to give the cash of 440 crore. And therefore, A Limited has to record that potential obligation today. But sir, today's date, though, there is no obligation. No, today's date there is not. But kal ko utke wo aa sakta hai na, it can definitely come. And if it will come, remember, we have been booking option contracts at fair value. Yes or no? तो यहाँ पे भी हमें करना पड़ेगा. We will have to book it at fair value. Yes or no? Okay, so that is why we will be doing the booking. Okay, so we will be recording an obligation. Acha, obligation will be payable now or payable after 2 years. Obligation is payable after 2 years. So time value of money will become significant, and therefore we will discount it. We will discount it. Let us assume that the rate is 5%. Okay, assume the discount rate is 5%. So therefore, this is a financial liability now. Financial liability, fair value. Rupees 440 crores into, you will be paying present value factor 5% second year. Okay, are we clear? 5.907. So this roughly comes to 400 crores. This roughly comes to 400 crores. Okay. This roughly comes to 400 crores. Okay. All right. Janvi, in the earlier cases that we did till now, we had not booked the obligation because the transaction was recorded at fair value. So the fair value movement automatically adjusted my derivative financial asset or financial liability. तो उसको बोलते हैं mark to market. So I was already booking it at fair value. Whereas in this case, the problem is the entry that you are passing is a derivative equity, and derivative equity is never remeasured. So what will happen is that 15 crore will appear at 15, 15, 15, 15 for all the 2 years. Suddenly in the second year, there is a shock. 400 करोड़ हमें भरना है. We have to pay 400 करोड़. ये दिखा क्यों नहीं था? Why didn't anybody tell us this? Yes, to mitigate that shock, we have to show this obligation. Only because equity cannot be remeasured. If it was a financial liability, I would do the fair valuation. That fair valuation would bring it to each reporting date's values, yes or no? And therefore, there was no need to book a separate obligation in the earlier questions that we saw. Is it okay? Yes? All right. So here I have to book this obligation at the present value. I have to book the obligation at the present value. Are we clear with this? Yes. Any doubt so far? Why we have to create an obligation? Is it clear? Yes. Everybody who is watching, can I proceed? Yes. So now obligation तो create करना पड़ेगा. तो obligation हम create करेंगे. Okay, this is year 0. Second entry, to liability component of put option. It's not a component per se, but I will just say that it is a liability component because if this put option is exercised, I have to pay it off. Okay. The question is still not over. Okay. So up till now, it works like this. A Limited entered into a contract with B Limited. क्या contract है? A Limited gives an option to B that you are holding my shares. You can sell those shares to me for 440 crore after 2 years. So A is the writer. A Limited sells a put option to B. So B Limited purchases a put option. Put option means right to sell, a right to sell. Whereas for A Limited, he wants to buy back his shares. See why A Limited does that is also interesting. It's not because A Limited के पास time pass करने के लिए time है. It is basically that he wants to do a buyback of his own shares. He basically wants to do a buyback of his own shares, and that is why A Limited is going to issue a put option to B. B Limited will then decide whether to sell or not depending on A Limited's pricing in the market. So 440 crore pe deal is fixed. After 2 years, B has the option to sell A Limited's own equity instrument at 440 crore. Since it is a transaction in own equity shares, the journal entry that will be passed is bank account debit, option premium. When A sells the options, B Limited will pay the premium. So therefore, option premium is 15. So entry will be bank account debit to other equity. Bank account debit to other equity. This is the entry that is going to be passed. Now, this is not going to be remeasured. Other equity is not getting remeasured. What happened in Samco and JT Bank is at every reporting date, the obligation was getting remeasured. At every remeasurement, at every reporting date, the obligation was getting remeasured. So therefore, the obligation would appear at fair value always. The obligation would always come and appear at the fair value. And that is why this is the fair value. We would always show it at this. And therefore, there was no need to create a separate obligation. There was no need to create a separate obligation because the contract itself was an obligation. However, in this case, the contract is equity. Equity is not obligation here. But if B exercises, A will have an obligation to deliver cash. Yes or no? वो कहाँ दिखता है? That is not visible here. Okay. And because that is not visible here, I will have to record an obligation. I will have to record an obligation. So the obligation that will be recorded is going to be discounted to present value. So 5% is the discounting rate. This will be given to you in the question. But I have assumed it is 5%. So therefore, I have to recognize a financial liability of 400 crore. I have to recognize a liability of 400 crores. Okay. So year 0, I'll just write it here. I didn't know so much space was there. To financial, or what we can say, liability component of put option. 400. Why put option? This is put option only. No, you have given a put option to B Limited, and because of that you have a liability. Okay, don't say that it is a compound financial instrument. It's not. But by virtue of that put option, we are now looking at a liability. So to liability component 400. Issue is, what are you going to debit? Sir, can I debit any asset item? Answer is no. You are not getting any asset. Okay. In fact, tomorrow you have to pay the you are not getting any asset. In fact, tomorrow you have to pay this amount if it rises. Okay, so theek hai, we will see that later. So what am I going to debit? Will it be any expense? Answer is no. So this is just other equity. This is just other equity, which is looking to buy back. Looking to buy back. Debit 400. Other equity for buyback account debit to liability component of put option. To liability component of put option. You cannot debit equity capital here because buyback will happen after 2 years. As on this date, nothing is happening. So therefore, you cannot debit equity capital here. That would be incorrect. You would still have shares in issue. Shares will come to you and then you perform the buyback. Okay. And then you perform the buyback. Is it okay? Yes. So this becomes other equity account debit buyback to liability component of put option 400. To liability component 400. Is it okay? Is it okay? Yes. ठीक है. Now the issue is can I remeasure this equity? Can I remeasure this? Answer is no. No remeasurement. Why no remeasurement? Because it is own equity. Because it is own equity. Because it is own equity. Is it clear? Yes. But can I remeasure the liability component? Answer is yes, you can. But tell me one thing. Is this liability component a derivative? मेरे को चलो अब ये बात बताओ. डेरिवेटिव बहुत पढ़ लिया ना सुबह से. अब बताओ, is this liability component a derivative or not? And if it is not a derivative, what it is? Okay. सोचो, सोच के जवाब दो, ठंडे दिमाग से जवाब दो. Okay. Is it a derivative or is it not? I'm talking about this liability component. This 400. The debit 400 is equity. The debit 400 is equity. This 400 is not a derivative. Sir, क्यों? This derivative, what is the underlying? कुछ नहीं है. It is an obligation to deliver cash. Tomorrow your share 100 only. And then you will get your answer. So basically, I have to pay 400 come what may. 400 plus that discounting which is there. Okay. So I have to pay 440 crore. 440 crores ka value is not dependent on anything. See, when I say underlying, the option contract paper, this paper which is there, the value of this paper depends on the market price. But the value of the equity itself, which you are fixing at 440, that uska underlying kidhar hai? There is no underlying. And because there is no underlying, it is a fixed amount that you have to pay. And therefore, this 400 is not a derivative liability. Is not derivative liability. It is an obligation. It is a financial liability. I don't deny that. I just am saying that it is not a derivative liability. वो derivative liability नहीं है. ठीक है? But it is an obligation to deliver cash. If the other party, B Limited, exercises this option, that sword will fall on my head. And because that sword will fall upon my head, it is an obligation. It is an obligation. ठीक है? So therefore, this 400 is not a derivative. Okay. Let us now come to that particular thing which I had discussed with you. I think I had discussed. Yes. Those six instruments which are accounted at FVTPL, whereas the others are always at amortized cost. What are those six instruments? Contingent consideration, financial guarantee. Are you able to recollect those six instruments? Yes or no? Bolo. I had given to you in writing. Yes. Derivatives, held for trading, contingent consideration, financial liability, continuing involvement approach, and the other one is liabilities designated at FVTPL. These six are going to be accounted at FVTPL. Remaining all liabilities will follow which method? They will follow amortized cost method. So now look at this 400. Is it a derivative? No, it's not. First one. Is it held for trading? Answer is no. I'm not going to trade this liability. The third one is it designated FVTPL? Answer is no, it's not. The fourth one is it a financial guarantee? Answer is no. It's not a loan that B Limited has taken, which I am guaranteeing. Is it a contingent consideration? Answer is no. I have just taken time to make the payment. I have not made it contingent on any profitability or earnings or so and so. So it is it is definitely payable, only passage of time is required. And finally, is it a continuing involvement approach? हमने पढ़ा नहीं है, but this is not that for sure. So it is not meeting any of the six criteria of any of the six items which require FVTPL accounting. So what accounting will I have to do? All other financial liabilities, I will have to do amortized cost workings. I will have to do amortized cost workings. Is it okay? Yes, amortized cost workings. So amortized cost means what? 400 will increase on account of finance cost, the rate of which is 5%. The rate of which is 5%. Okay. So therefore, what is the entry that you are going to pass every year? The entry that you are going to pass every year is finance cost account debit to financial liability 400 into 5%. 400. No. Contingent consideration is different, Kaushiki. वो आपने पढ़ा नहीं होगा. Have you done Ind AS 103? Have you done Ind AS 103? ये वो वाला contingent consideration है. It's not the contingent consideration in that sense what you're telling. Okay. So that is Ind AS 103. All right. So now year one. Accrue the finance cost. So finance cost debit to liability component. Finance cost P&L debit to liability component. 400 into 5%. So this comes to 20. Yes. And year two. Finance cost debit to liability component. Okay. So this comes to how much? 420 into 5%. That also comes to approximately 420. 21. Okay. 20, 21, all that is okay. All right. Oh, ultimately it rounding off and then it comes to 20. Okay. All right. So this takes care of year one and year two finance cost. Are you clear with this? Yes. Are you clear? So ultimately the liability has increased to 440 crores. Okay. Ultimately it has increased to 440 crores. Is it clear? Yes. So far, is it clear? I have remeasured using amortized cost principles. Yes. All right. Now, finance cost is done. Obligation appearing at 440 crore. So therefore, we now have two options. What am I having as by closing balances? End of year two. What are your closing balances? I have financial liability or liability component appearing at 440 crores. Okay, 440 crores. Next. Year two balance. I have other equity. Option. Put option. So this is 5 credit. This is initial recognition. That is what I have done, right? नाम क्या दिया मैंने उसको? To other equity, put option 15 crores. Okay, this is the balance. Then what other balance I am having? Well, I'm having other equity. Other equity. So this comes to how much? This comes to 440, 15, and this is 200, 400 crores. Credit, debit. Are we clear with this? Only this is a derivative. Remaining top and bottom both are not derivatives. Both are not derivatives. Is it okay? Yes. All right, fine. Now, all right. Now, I will have settlement. Two things can happen. Either B Limited will exercise the option and sell my own instruments to me, or B Limited will not exercise the option and let the instrument lapse. इन दोनों के अलावा कुछ नहीं हो सकता. It's either he lapses, in which case I have to pay, or he does not lapse, in which case what needs to be done, we will have a look at it. Okay. So therefore, option 1, year 2, settlement. Option 1, holder exercises option. Okay. Holder exercises the option. This is my derivative. Okay. All right. Holder exercises the option. So what is the entry? First of all, I have to pay him 440 crore. Do I have liability appearing at 440 crore? Answer is yes. So the entry will be financial liability account debit 440 crores to bank 440 crores. Okay. This is the first entry. Second entry is now iska to baat khatam ho gaya. This is removed 440 crores. Now what is left with us is 400 crores other equity, that is a debit balance, and 15 crore other equity, that is the derivative option. Since I'm getting the shares back, can I say that both the derivative equity as well as the other equity debit which is there, can I say that both of them have to be reversed? Yes, because anyways I'm getting my shares back, so both of them have to be reversed. So therefore, what am I going to do is I will credit other equity to other equity. What is the journal entry I had passed? Buyback to other equity. Buyback. This is going to happen at 400. Similarly, I also had 15. What is 15? The derivative equity on initial entry. So other equity, put option. So therefore, what is the balancing figure? 385. What is the balancing figure? Can anybody tell me what is the balancing figure? This is nothing but the shares which are bought back. Equity share capital / securities premium or other reserves. Okay. Equity share capital / reserves. Are we clear with this? Yes. If the option is exercised, first of all, I pay off the liability. Liability account is closed. This we can write it as liability component of put option. Is this paid? Yes. Then the shares come back to me. So if the shares come back, my own shares come back to me, then first of all, the other equity 400 which I had recorded as a debit will now be credited and reversed. The equity derivative that is there, 15, that is also lapsed now because the shares have come back. So therefore that derivative काम जो था उसका वो खत्म हो गया. So it cannot continue to remain in the balance. So debit other equity put option and eliminate that. The balancing reserve is what the balancing figure is ultimately what goes in your equity share capital or reserves. Okay. It will be adjusted in whatever manner possible. But यही दो जगह पे जाएगा. Is it okay? So this is the settlement that happens. Now, if there is no settlement, that is option lapses. Option lapses. In case this happens, what do I do? What do I do? Okay, so therefore, इसको नीचे लिखना पड़ेगा. Option 2, the option lapses. If the option lapses, do you have an obligation to deliver cash? Answer is no. That means that liability has to go away. So liability account debit, liability component of put option debit, 440, correct. And against this liability, I had created this other equity debit. So I will credit that to other equity buyback 400. So I am going to be left with 40. I am going to be left with 40. What is this 40? Unfortunately, there is no guidance given here, but typically we can shift it to retained earnings. There is no guidance for this, but we can shift it to retained earnings. Some authors prefer to shift it to the profit and loss also, but we stick to retained earnings. P&L I cannot shift. It's not right to shift to P&L because what is this 40? This 40 is ultimately finance cost. See, year 0 to year 2, I had done the amortized cost working. So 440 became 400. You can see here only on account of finance cost. Finance cost has already hit the profit and loss account in years 1 and 2. The fact that time has passed, nobody can deny it. So if nobody can deny passage of time, nobody should question that finance cost has hit the P&L or not. It has hit the P&L. And therefore, I cannot resurrect that 40 through the P&L. I will instead transfer it to retained earnings. This is what appears to be correct, but alternative solutions say that it can go to the profit and loss. It can go to the profit and loss because standard is quiet about it. Standard is quiet about it. Okay, all right. Next one. You have that other equity put option 5, that all the 15, that also has to get eliminated. Okay, so other equity put option debit 15. And where do I transfer this? Same to retained earnings. 15 to retained earnings 15. See, this other equity put option is basically what you used to do when employees used to exercise the option. We used to debit SBP reserve, yes or no? So it is same like that. It is same like that. If options lapsed, then also we used to debit the reserve, yes or no? And transfer it to retained earnings. So the same thing is what is happening here. Are we clear about this? Yes. Are we clear about this? Any doubts? Any doubts so far? Yes. Any doubts? No doubts? Come on, tell me. Are we having doubts or is it clear? For 15, we cannot transfer it to P&L. 15 is an other equity component. So other equity component will ultimately go to retained earnings only. See, between an owner to owner transaction, you cannot move the amounts to the P&L. For instance, you buy a partner's profit share. Where do you make that adjustment? You make the adjustment in partner's capital account. You do not take it to the profit and loss. Are you correct? Yes or no? Are you able to follow? Any partner share is being bought. The excess that you pay or adjust, where do you route it through? You route it through the partner's capital and not through the profit and loss account. Why? Because partners are owners, whereas business is a transaction with outsiders. Similarly, here B Limited also held my shares and A Limited is buying back its own shares. I mean A Limited's own shares. So it becomes an owner to owner transaction. Okay, it becomes an owner to owner transaction. We cannot take it to the P&L. We'll be shifting it to the retained earnings. We will be shifting it to the retained earnings. Is it okay? Yes. All right, fine. So now we'll just quickly write something for this and we close the session. Okay. All right. So you can give the heading. Obligation to purchase own equity shares. Obligation to purchase own equity shares. An entity writing an option. Writing means selling, but we don't use selling with option. We say option writer. An entity writing an option to purchase, which is nothing but to purchase, that is buyback its own equity shares, must, in addition to the equity derivative, present value of the redemption amount, at the present value of the redemption amount. Where the commitment is to buy back fixed number of own equity instruments, where the commitment is to buy back fixed number of own equity instruments corresponding effect will be against other equity. Okay. All right. Will be against other equity. Have you written this down? Have you written this down? Yes. Once you have written this down, please let me know. Once you have written this down, please let me know. Okay, all right. Now, just write this example. Okay, note down this example. Note down this example. Okay. I'm not giving it in words because the crux is you understand the concept. Okay. Otherwise, I can give you in words. A Limited enters into a contract with B Limited to buy back its own shares. Okay. That is simply taking time. So you can note this down or take a screenshot if you want it faster. Okay. Namrata is there or she has left? Nobody is there. It's just Kaushiki, Jahnavi and myself. I think so. Boys, Viraj, are you guys there? Vidit, Viraj. Okay, done. Have you noted the example part? Yes. Okay, Panu is there. Good. Okay, fine. So this is done. You can write, is it a derivative? Just write these indicators. Okay. To other equity put option. I will just give you some note here. The put option is a derivative, and since settlement is for a fixed number of entities own equity instruments, comma, it would be classified as equity. It would be classified as equity. So basically, this is a pure equity derivative. Pure equity derivative. Earlier seen in compound financial instruments as well as share-based payments. Okay, this is a pure equity derivative. This is a pure equity derivative. Okay, earlier we had seen this in compound financial instruments, equity component of a compound financial instrument. We used to do the segregation. But in this case, this is a pure equity derivative. Okay, because it's purely to buy back your own equity instruments. Okay. Oh, okay. Amrita is there. Good, good. Okay. All right. Fine. Okay. Once you have noted this part down, before you write the first entry, before writing the first entry, just wait. All right. Okay. Now, since A Limited is under obligation to deliver cash after 2 years, comma, financial liability is created at present value. At present value. You can write this here, and here you can give the working below the journal entry as 440 into 0.907. That is present value of, PVF, 5% second year. Okay. PVF 5% second. 5% is an assumption, obviously. 5% second year. Okay. You can write this no remeasurement as it is own equity. Okay. So this is crucial because what happens is the question may tempt you to do a remeasurement by saying that fair value of this is so and so. Okay. So that is why you can kind of write this and keep. So even if fair value of equity components are given, you don't have to consider it. You don't have to consider it. Okay. So this takes care of that part. No remeasurement as it is own equity. Okay. I hope you have written this. It's become quite a mess, but it's okay. All right. All right. Then first one is amortization. Second one also is amortization. See, you should be in a position to solve questions related to compound financial instruments. You should be in a position to solve basic derivative questions. There is one particular derivative question that you may not be able to solve, which involves separation of embedded derivatives. So that we'll be covering in the next session. I'll not be doing it today. So that you cannot do. But by and large, about, you can say 75 to 80% of your exam requirement we have been able to complete successfully, I hope. Okay. So off market transactions you can do, compound financial instruments you can do, identification of financial asset, financial liability, those questions you can do. So these will comprise of at least 75 to 80% of the questions minimum. Okay. So you should be in a position to do it, those questions. The remaining ones, derecognition is pending. We'll be doing, it's a small topic. Then we are having expected credit loss model on trade receivables. That is a small topic. And then separation of derivatives. These are small topics. So once we do this, I'll be doing questions, then doing these topics, then questions. So therefore, I'll try to complete all the questions, all the topics in the next 2 classes. Okay. You don't have to worry. All right. So note down these two entries for amortization with the closing balances at the end of year 2. Closing balance year 2. All right. Just just note it or take a pic, whatever is okay for you. All right. All right. Panu, are you able to follow? Viraj, we'll have to check. Okay. Noted. Okay. So then the last thing what you have to do is settlement. Just take a pic of this. The paragraph below you would have already noted down. Okay. So take a pic of this and we are done for the day, or you note it down. Okay. Option lapses or holder exercise is the option. So both the cases we have discussed the impacts. Okay. Oh God. Because most of the questions that I have done is from your study mat. Why most? All the questions are from study mat, RTP here and there. Okay. So should not create an issue. Okay. All done. Noted down. Any difficulties? Okay. Now, what I want you to do is for the next week, we don't have a session from tomorrow till Friday. Till Saturday. Next Sunday, we are having a class. So what I want you to do is, I would like you to go ahead and revise whatever we have done. We have done quite a substantial chunk. Okay. So revise. There will be cases where you end up getting stuck. Doesn't matter. Even if you get stuck. Okay. Reach out to me. Okay. Feel free to reach out to me. fr-final@icai.in. This is our email ID where you can reach out. Okay. I think Shubham had asked. I was not in a position to answer at that point of time. But yeah, reach out to me. But at least going by the way you guys have responded, solved, I don't think for the topics done, you will face much of a difficulty. We have one or two things here and there which we have to do. We'll be doing that. Okay. All right. So can I close the session with this? Yes. Kaushiki, Janavi, hope you have noted. With that, we close the discussion for today's class. We shall resume next Sunday. Revise and come. Revise and come. Okay. Next Sunday, please revise and come so that we can, complete faster. Okay. Solve more questions. The more efficiently you revise, the more questions we get to solve. Okay. Thank you. Thank you, Panu. Thank you, everyone. And have a good day. Have a good weekend. I have eaten a lot of your weeks and weekends. Okay. Next Sunday, we meet again. Okay. Thanks, everyone. Thank you.